very good morning. You're watching India Market Open, and it's been a relatively peaceful weekend, but we're coming out of one of the worst trading weeks, Tamanna. 2024's worst week. The index is down nearly 5%. Broader markets are weak. Bank Nifty sold off. It was painful, but this morning we're staring at a little bit of respite.
A fair bit, I would say. And yes, it was a bad week. The last 2 days was actually more than anything else where that pain was sort of bunched up. But if global cues are anything to go by, I think you might have a bit of a bounce back, at least in the morning trade. The only fly in the ointment, if anything, was the exit poll numbers which came out from 2 state elections, which become a bit important because these are the first set of elections after the Lok Sabha. But let me come to global cues first. And what a fantastic Friday trade for US markets because of just much better than expected jobs numbers. Blowout numbers is what I would say. So the positive jobs data ensured that the Dow jumped over 300 points. The Nasdaq also in fire. Dow futures are still positive as well. Nasdaq was about 1.5% up in trade. So let's come to that data. Remember, we told you September non-farm payroll data becomes very important, and becomes important because the proof is in the pudding. Has the Federal Reserve managed a soft landing where you've managed to control inflation and not disrupt the economy? That was the task. At least the September non-farm payroll data seems to suggest that they have ended up managing this feat. So the data showed that these jobs grew to 254,000. Remember, the estimate was 150,000 jobs in September. So a huge difference there. The unemployment figure also, which was expected to stay steady at 4.2%, was actually better, down to 4.1%. So these factors combined has ensured that the outlook has been very positive. It flowed into bond yields as well. So you had the 10-year inching up on those hopes of achieving a soft landing. So far, so good. Now, let me come to the crude bit of it, because that's where things have been a little jittery with the fears of escalation between Iran and Israel. It cooled off. Oil has been cooling off because of Biden's commentary that Israel is not attacking Iran's oil facilities right now. And look at what Biden has said. He's very clearly said that, we're in conversation with them. And if I were, Israelis have not concluded what they're going to do in terms of a strike. That's under discussion. But the second part of what he says becomes even more important, where he says, if I were in their shoes, I'd be thinking about other alternatives than striking oil fields. This was, remember, Biden trying to come back and explain his comments from last week, where he said it's under discussion, and then, markets sort of really panicked. So good on the crude front. Gold, as a result, has also slipped off because that crisis feeling has gone off. Asia has opened strong. The Nikkei up over 2%. Of course, the big point as far as Asian markets in India is concerned becomes the RBI monetary policy later this week. Pull up the implied open and we'll see how we're set up this morning as well as India is concerned. So you have 67 points in the green. So you can expect that bounce back. But just to recap what the DI, FI kind of flows have been, and this becomes the big factor. Do FIs continue selling? Because huge spate of selling. Remember, October 3rd, 15,000 crores. October 4th, that was Friday, 9,897 crores of sales by FIIs. DIs do come in to buy in 8,905 crores. But of course, we saw that panic hitting the Indian markets. Does that continue? Koon Go joins us now. He's head of Asia Research, ANZ Research. Very good morning to you from where we're sitting, Mr. Go. Thank you so much for joining us, and pleasure speaking with you. Just trying to understand how the jobs data in the US will be seen going forward, and this interpretation that the Fed has managed a soft landing, hence at least US markets will stay steadily upwards. Is that the right way to look at it?
I believe so. I think there were a lot of concerns about a potential hard landing, particularly when the unemployment rate was heading higher and it triggered the so-called sham rule. But since then, we've seen the unemployment rate fall back towards 4.1%, as you mentioned, plus the monthly non-farm payrolls number continue with these outsized gains. It's very hard to see the U.S. economy going into recession when you have such a strong labor market. So therefore, the hard landing concerns have faded away. And it very much looks like the U.S. economy is heading for a soft landing. Now, importantly, this doesn't mean the Fed will hold off cutting rates. And this is really crucial because It's really the lower inflation numbers that is giving the Fed cover to ease rates and bring them back towards neutral. And whilst we don't expect the Fed to go big again like they did last month, but we're looking at more incremental 25 basis point cuts from here until we get the Fed funds rate towards 3.5%.
Koon, hi, good morning. It's also Samina joining in. FIs have been underweight India for most part of this year. Now it seems incremental money is moving into China. How does India stack up for a foreign investor like yourself?
Look, the India macro story is still very, very positive from a long-term perspective. But, we have to acknowledge the Indian equity market had a very good run, particularly when China and the Chinese economic outlook was under a cloud. So we've seen a lot of inflows having gone into India, not only on the equity side, but importantly on the bond side as well, due to index inclusion. Now, we're starting to see interest returning to China, particularly around the equity market because of the stimulus measures that was announced 2 weeks ago. And the strong rally in the Chinese equity market, coupled with low valuations and basically the world being underweight China, is starting to see a bit of that rotation happening right now. Now, there's still a lot of uncertainty. I would say maybe skepticism on some part around whether or not the Chinese stimulus measures this time will really move the needle. But I think investors at this stage are at least giving the Chinese authorities the benefit of the doubt. So we might start to see some allocation of funds back into China. Some of that might come from other parts of the region, including India. But this is a short-term cyclical type of rotation. I think we shouldn't lose sight of the fact that over the longer term, I think the structural story for India continues to stack up very positively.
Recommending investors to buy India right now because, like you said, it's a structural long-term story. And the fact remains that we've sold off quite sharply. While the index is only down 5% last week, broader market stocks are down anywhere in the range of 20 to 30% from their recent peak. So if you look at rupee buy values, you'd get a lot more right now. So if you believe it, will you sell it?
Well, I think the rupee is a completely different story because we continue to see the RBI managing the currency very closely. So that's not going to be the main bulk of where the gains are.
What I meant
in terms
is
of the equity market, I think valuations do play an important point. And as I said, everything is relative. And at the moment, there's a lot more excitement, I guess, in the near term in terms of what's going on in China. So we might start to see, China taking some of the glamour for the near term, shall I say, until we see, where this rally in the Chinese equity market ends up.
Yeah. Koon, just in terms of the outlook for India, you said that the long-term story remains positive. What we're seeing in terms of the move towards China is a rotational play. When do you see that cycle sort of reversing and flows coming back to India?
Look, I think some of these rotation can take a few months, to be fair. We have seen a lot of foreign investor outflows from China, particularly in the last couple of years. So it might take a while for the foreign inflows to get back into China, particularly as it seems like we are only at this early stage since the stimulus measures was announced only a couple of weeks ago.
Koon, quick question. What is the outlook on crude? Are you long crude? Are you long gold? And also, would you buy metal stocks in India or across the world?
But we remain quite positive on gold. We believe that, despite gold hitting all-time highs, we believe there's, further upside for it, particularly given that there is ongoing strong demand from central banks as they continue to increase their official FX reserves allocation into gold. And I'm talking about, physical gold demand here, coupled with their ongoing retail demand from emerging market countries. So I think there's still, further potential upside for gold, particularly as we continue to see potential for the dollar to weaken, notwithstanding the recent rally that we've seen since last Friday. But as the Fed continues to cut rates into next year, we expect the dollar to continue to slip over, and that will provide support for gold.
Right.
In terms of crude oil, just very quickly to round off, we anticipate crude oil to hold up at the moment because of the ongoing geopolitical tensions that's happening in the Middle East. But as we head into next year, and if these stimulus measures from China do start to see growth, particularly domestic demand, making a comeback in China, that's going to improve and increase demand for global crude prices, which will start to see crude heading high into next year. So we are looking for a recovery in Brent crude oil prices back towards $80 a barrel by next year.
There's a barrel on crude, and that can't be good news for an economy like India. But Koen, great talking to you. Have a good week ahead, and we'll speak to you soon. With that, a quick check on how the implied Nifty is looking. Tamanna highlighted that it seems like there's going to be a gap up that we're setting ourselves up for. A 72-point up move is what's expected. But remember, we're coming out of a very rough week. In fact, the Nifty lost 1,250 points from its record highs, saw its highest ever single-day sell-off from foreign investors on Thursday, and had its worst week ever since 2022. Broader markets did slightly better than the benchmark. The broader markets were down about 3% in trade, and 17 lakh crores of investor market cap was actually eroded in last week's trade. Portfolios were deeply in the red. NAVs have also declined quite sharply for most portfolio investors. HDFC Bank, ICICI and Reliance had a very tough last week of trade, all those three stocks losing quite significantly in trade and not witnessing low-level buying that we saw on Friday. Bank Nifty is also looking weak. Remember, the rally started on the 11th of September, where the Bank Nifty had gained 3,500 points. And it turns out we've given up pretty much most of those gains, down 3,000 points from the September 11th rally. Auto, bank, oil and gas declined about 4 to 6%. October futures have added 3.5% of open interest on Friday. And the PCR, which is the put-call ratio, has also declined to 0.68, indicating that the bias towards the buyers is much higher. Well, oil was up 10%, like we said, in the last 5 days, and that couldn't be good news for the street. The VIX also saw a jump of nearly 18%. So it was a rough week, but the good news is, as Tamanna had highlighted, global markets are looking stable this morning. Jobs report from the US doesn't look too bad. But remember, back home, we are going into a week that's event heavy. You have the RBI policy on Wednesday, which will give us indication of what the Reserve Bank of India is thinking. Nobody is expecting rate cuts, but a change of stance is what the street is anticipating. Come Thursday, earnings season kicks off with the likes of TCS, Tata Elxsi and Irida to begin with. Along with that, 25,000 remains a very important level of support. Remember, we intermittently dipped below that on Friday, but some selling came in and the Nifty managed to close about 25,000. So that becomes very critical for traders to watch. The belief is that while there could be some respite and consolidation of the positive bias is expected, the rally could be led by sectors that declined the most last week. So banks, auto could be seeing some buying in trade. IT is done okay. It is expected to remain on the sidelines ahead of the earnings season that kicks off in Thursday's trade. Apart from that, you have 24,750 as well. That's a key level on the Nifty. Any close below that will mean intensified selling pressure. Keep a track on Bank Nifty as well, because that becomes crucial with the kind of selling some of these large banks have seen. Expectation is that in HDFC and ICICI banks, or the PSU banks, will see buying emerging in today's day of trade. But I believe, Tamanna, apart from everything else that I've highlighted and we've highlighted, counting of votes for both Haryana and Jammu Kashmir also becomes important for the markets to track.
So the counting takes place tomorrow. We had a cut of exit polls over the weekend, and in itself not large states, but only important from the point of view, Samina, that these are the first set of elections after the Lok Sabha elections, and people will be waiting to see which way the political winds are going. And exit polls so far are pointing to a Congress comeback after 10 years in Haryana, and the Congress and National Conference combine ahead in Jammu Kashmir. Jammu Kashmir also becomes important because first polls after 370 was abrogated. So that's one to watch out for. But from a larger markets perspective, that might not be the biggest factor.
Not as significant.
I think today what will continue to be watched is the extent of FII outflow.
Yeah, for the month of October, we're at already seen a sell of 30,000 crores.
And it's just been a week. And I think that this whole theory that we've been talking about in the market right now, that don't worry about FIIs, DIIs are standing strong, that's really being put to the test right now. That because the narrative has been, oh, who needs FIIs? You have strong retail investment inflows coming in. No, this is what happens when FIIs start heading towards the exit door.
I think my other concern is, while the FIs have been selling off, you're also going into a very event-heavy week. And it's not just FIs selling India. What we've seen is bond yields, which is risk-off assets, have been doing quite well. And I think we discussed this on Friday, where the Nifty is up about 20+% year to date. Hong Kong has made such a strong comeback. It's up 30% in the last 13 days. The Hang Seng ETF, which is tracked quite closely for any investor in India who's looking to diversify, is trading at a 5% premium. So that is the kind of opportunity that those markets are, offering. We've always been expensive. FIs have largely been underweight India. But in other news, this is going to be a week when you may see some more secondary action. It could be a good thing because primary markets are relatively quiet. So you don't have too many subscriptions opening. So any sort of incremental money and, of course, long-term investors would start nibbling on equities that are available nearly 30% cheaper than they were a week ago.
Possibly people are shoring up for the big slew of IPOs that will come in as well. So watch out for that. All right. Meanwhile, top stocks on our radar this morning, and I'm going to start off with BSE. BSE only because, look at that stock all of last week. A winner while every other section was pretty much flailing. So up 45% in the last 1 month, 4% just in Friday's trade. And so why BSE again? A couple of announcements over the weekend which I think might boost it sentimentally, so which is why we're giving it a thumbs up. For one, its wholly owned arm, the Asia Index, has launched 3 new indices, including BSE Power and Energy, BSE Sensex 65 and BSE Sensex 60. What I also found important is that SEBI has cleared another hurdle for the NSE IPO. And we'll get a report in from my colleague Charu on this a little later. So that means that there's one major Supreme Court order remaining for NSE to come in with its IPO. And an NSE IPO, whenever it does come in, is expected to have a re-rating for BSE and that entire space. So you could see another good day for the Bombay Stock Exchange. Jio Financial Services was the other one. So Jio Financial and BlackRock have now received a SEBI note to set up their mutual fund. The proposed mutual fund will see both as co-sponsors, so that sort of sets the stage for them. That becomes a positive for Jio Financial. And Bandhan Bank as well is getting a thumbs up. Now remember, there's been a whole host of business updates. Business updates is the name of the game, and I think going forward what Q2 looks like, business updates looks like, is going to be the biggest factor in the market, more than what's happening globally or politically or domestically. In that sense, Bandhan Bank did fairly well. Harsh will come in a little later in the show to tell you about all of the updates, but I'm picking Bandhan Bank because advances up 21% year on year, 4% Q on Q, deposits also growing well, 27% year on year, quite astonishingly good at a time when banks are struggling for deposit growth, up 7% Q on Q. Their CASA is looking good at 47.2 thousand crore, up 10% year on year, up 6% Q on Q, and their CASA ratio is at 33.2%, down 20 basis points. This is also the first set of numbers we're sort of seeing from Bandhan Bank after the change in management, which was seen as a big knockdown for it. So thumbs up for Bandhan Bank. Let's see how they fare. But so many stocks to discuss because of the slew of business updates, Samina.
Just, Tamanna, you mentioned NSE, right? And just to put some perspective on that, about 4-5 years ago, when it was available in the unlisted market, you could get NSE at 800 rupees. The current price of that is 7,300 with a market cap of $36 billion. Net profit margins are at 60%. operating margins are at 80%. So this is just the kind of euphoria. And if you're looking to buy it, which I know a lot of people are still trying to scramble and pick up those last sort of pieces of the stock before it lists in the markets next year. But this has been a story, and I think the euphoria on NSE has actually led to, in some ways or in many ways, investors, seeking value in the primary market. But a story in itself, very, very strong numbers. The growth's been phenomenal. And the stock, like I said, has gone from 800 to the last traded price of 7,300 in the unlisted space. But a few more counters, and we mentioned that there are a whole bunch of business updates, and we'll do a lock, stock and barrel on banks. But a few that stood out for me is Titan. Good numbers. Total business has grown 25%. Jewelry segment rises at 26%. Eye care division has reported a growth. Emerging businesses are 14%. Carrot Lane has also grown 28%, and they've added 75 stores, taking the total number of stores for the Titan Group to about 3,171 crores. So good sort of business update coming in from Titan. Real estate developer Macrotech and Godrej also managed to do quite well. Macrotech posted its best quarter ever, pre-sales at 4,290 crores. They're on target to meet their full year guidance of 20%. And they've got 4 new projects in Pune and Bangalore with a gross development value of 5,500 crores, which will be reflected in their earnings in the quarter. Godrej Properties has also done relatively well. Very, very strong quarter. Best quarter ever for them too. But I'll quickly tell you a quick update on ITC. May not move the stock significantly, even though ITC may turn out to be a gainer, because on Friday what you saw was FMCG and consumption stocks leading the way down for the markets. But as expected, the NCLT has approved the hotel demerger. Shareholders of ITC will get 1 share in the demerged hotel business for every 10 shares held. This is largely in line with what was expected. And they will, of course, raise capital from the equity and debt market. So this update, par for the course, the stock will gain not because of this news, but just because of the fact that it's 1 step closer to the demerging of the business. But apart from that, like we've said, it's all eyes on what comes out of the polls. And Tamanna, of course, tracks that extremely closely. Tamanna, back to you discussing the 2 important states.
All right, so exit polls were out over the weekend for results in Haryana and Jammu and Kashmir. Now, this comes, of course, with all the standard disclaimers about exit polls. They were proven terribly wrong as far as the Lok Sabha elections are concerned. So please take it with a pinch of salt and those statutory warnings, so to speak. But so this is the picture as far as Haryana is concerned. 90 seats in the assembly. This is the poll of poll breakup, which is showing Congress at a lead with 55 seats, BJP with 24 seats, and the JJP, which was in alliance with BJP, losing quite a bit of share with just 1 seat. So this means, if these polls are correct, that Congress returns to Haryana after 10 years. And then look at some of those detailed polls, and we'll be speaking to one of India's top pollsters in just a minute from now. But they're also showing the kind of pain that you would expect coming in for Haryana. Jammu and Kashmir, meanwhile, let's look at Jammu and Kashmir, important election, because it's happening after the abrogation of 370. And here you're seeing the alliance between the Congress and the National Conference ahead at 55 as per poll of polls. BJP with 26 seats and PDP with 8 seats. So this is going to be another interesting one to watch out for. Now, why is this important and what does it mean? And that's why are we talking about this from a market's perspective? First of all, this is because exit polls are indicating a victory for the Congress in Haryana after 10 years. This is a fractured mandate, which is showing in Jammu and Kashmir. So it's still a bit, out there on what really could be seen. Another reason why these are important is because they'll be closely watched. You are seeing the results coming in on 8th October, and that becomes important as well. You also have the first set of polls which are being held after the Lok Sabha elections. And that's crucial as well, because remember, the Lok Sabha numbers were not as per what pollsters were expecting and what was seen as what BJP's outcome would be. So the question really is that, are you going to see a setback for the BJP in these state elections ahead of Maharashtra elections, which becomes very, very key, will take place this calendar year as well. So those are some of the reasons. The street will gauge which way the political winds are blowing after the Lok Sabha. Remember, there's a coalition government now, and which is why these polls also become important to watch. And also with the disclaimer that exit polls have really been questioned after what we have seen. But to talk more on this, I'm joined now by Pradeep Gupta, Chairman and MD of Axis My India. Pradeep, so excited to speak with you on NDTV Profit. And you are, of course, one of India's best known pollsters, sticking your neck out there once again with exit polls. So, you know, that itself, I think for all pollsters, this is now a very tough game after what's happened in the Lok Sabha. But what are the trends showing us thus far when it comes to Haryana? Let's start there.
Okay, Tamanna, good morning to you and your viewers, everybody. And thank you for having me here. Now, coming to Haryana, as you rightly asked, see, I'll tell you, each state has different political dynamics. So it definitely varies from the national dynamics for sure. And when it comes to Haryana, the beauty of Haryana is that in 10 years back, BJP came to power with 33% vote share and they secured 46 seats. In 5 years back, BJP vote share increases to 36.8 to be precise, and their seat share reduced from 46 to 40. And this time in our exit poll, Axis My India exit poll, it looks like BJP is likely to secure around 35% vote share. And seat share is reducing drastically this time to 18 to 28, as you mentioned in your poll, this thing, about 20s. BJP seats are likely to be around 20s. It may reduce to intense also. But what is more important to see here is that, as I mentioned, each state has a different political dynamics. Here, what is happening is the JJP, which was the regional party of Dushyant Chautala, which is completely significantly reduced to 1 to 2% vote share, which has 15% vote share last time. So that is the bulk of the JJP votes is shifting towards the Congress. And what you see here is the Congress is likely to win for sure in this Haryana election. Again, I am saying this is the exit poll predictions, but Congress victory is quite evident.
Okay, so now, Pradeep, from a perspective of our viewers this morning, what they're going to be trying and understanding is how significant is this outcome if this is what we see on the 8th of October from a national perspective. You have another very important state election coming up. These are the first set of polls after the Lok Sabha election, and people are going to try and gauge what this is telling us about the national mood as well.
So when you talk about the national mood, there are 2-3 different demography and segment of the society. One is of course the media and the stock market, and second is the political party who are in the fray, and third is the people, the common man. Now from a media perspective, yes, they're going to be a talking point that where is the wind blowing and etc., particularly in Haryana and Jammu and Kashmir. And as I'm trying to repeat it, each state has a different dynamics altogether. As I mentioned, though BJP vote share is reduced, but sometimes seats are increased. So totally different dynamics, the local dynamics at play. Now coming to the national and to the political party, yes, the political party, cadre base, Karyakarta, members, they get boosted with one victory or the another. And that will be the scene in political, among the political parties. When it comes to the common man, see, common man is a very simple and straight. They see what is coming in their way, as in what political parties and leaders has promised 5 years back, and what is delivered during these 5 years, and what is the promise for the future by different political parties. And they evaluate their voting preferences very carefully, because trust me, about 80% of the total 100 vote cast, I'm talking about those who have turned out for the voting, their livelihoods largely depend on the government of the day, directly or indirectly. So they choose or elect the government very carefully. So for a common man, they will have to see and do the assessment what is there for them before voting.
Okay, so this is not necessarily a reflection of what's happening on a national scale. Every state has its own dynamics, and Haryana specifically so, Jammu Kashmir, of course, in a very, very kind of specific situation. Just a comment, Pradeep Gupta, on Jammu Kashmir and what the exit polls are telling us.
See, again, when you move from Haryana to Jammu and Kashmir, though it looks like a one state, but the quite reality is that there are two states within one state. One is the Jammu segment and another is the Kashmir. Totally different dynamics as far as the demographic difference is concerned. The Kashmir Valley, where BJP has never win any assembly seats, and in Jammu, whatever number of seats they are getting in last 10 years back, they secured 25 seats. This time they are likely to secure about 30 odd seats, meaning their seat share has increased. But on the other hand, this time Congress and NC, National Conference, has formed the alliance and they are coming together, which they fought separately in 14. So they are ahead, much ahead than the BJP as a single largest party when it comes to the BJP and the alliance. The alliance in our poll is likely to get around 35 to 45 seats. 46 is the majority mark. So they are very closer to form the government, but there are so many as 20 small and individual candidates who is in the fray and likely to win. So it is like that, around 40 seats for the NCP Congress Gathbandhan, 30 odd seats for the BJP, and around 20 seats for these smaller parties, which includes PDP also, which has been a regional party of Jammu and Kashmir. They are likely to win about 5 seats. Then there are Rashid Engineers Party, the newly emerged Rashid Engineer AIP Party. They are likely to get around 5, and 3 by Sajjad Loans PC, and 2 by Altaf Bukhari's AP, and 5 individuals. So these 20 seats are the candidate and the parties is going to decide the fate of the new government in Jammu and Kashmir.
So interesting times ahead. Thank you so much, Pradeep Gupta, for speaking with us, and we look forward to chatting with you once the results are out on the 8th as well, and decode that. You can't get a better understanding of the numbers than with Pradeep Gupta. We'll take a very short break, but we're right back on India Market Open with all the action on the F&O side of things. Stay tuned for that and more.
Welcome. This is India Market Open. We're taking stock of how things have fared last week, and it was a challenging one. There's no doubt about that. We did see a little bit of weakness seep in, but are we looking at a bout of short covering today? Well, at least the implied open stream seems to suggest so. So let's start by taking a look at how things are faring there. About a 76, 77 odd point up move as far as the implied open is concerned. And should that sustain, can we in fact once again see a return of strength of sorts ahead of the earnings season, ahead of the RBI policy this week? But let's take stock of how things fared as far as Friday goes. And it was a weak day of trade. We know about that. We saw about a % cut for the spot Nifty, and the October futures did see an addition in open interest towards shorts. The bank Nifty, the picture wasn't any different. We saw about another 6.5% added in open interest towards shorts as well. Pardon me. Even as we move lower down, it does seem like we're going to see a little bit of resistance, or rather support, pardon me, around the 25,000 mark. It's a round number. Even besides that, there is a little bit of writing of puts around there. And, again, it's the range between 24,800 and 25,000 is what we're going to keep an eye on. It is certainly going to offer stiff support at the moment before the Nifty edges even lower. On the higher end, we once again are starting to see a little bit more writing around 25,400, 500 calls, and that's where that potentially could be the upper bound of the range, at least in this week. Moving on, it wasn't a great day of trade when it comes to stocks either. We did see shorts in names like Tata Chemicals, Apollo Tyres, Godrej Properties, as well as M&M Financial. A lot of these names like Godrej Properties once again will be in focus on account of their quarterly update coming through. In terms of other stocks that are in focus, we have long unwinding in Granules, Balrampur Chini, and some sort of short covering for IDFC and Gujarat Gas. So all in all, a very, very mixed day of trade, but inclining towards the downside. The question really is that where do we go from here and how do we move about as far as these markets are concerned? Well, let's get in an expert opinion. We have Akshay P. Bhagwat of GM Financial, who's joining us on the show. Akshay, good morning. Thanks for joining in. Let's start off with the first stock, which is on your radar. I believe you do have a spread working out there. What is your analysis on that, and why are you deploying that particular option structure here?
Good morning, Agam. So the first trade recommendation is in Infosys, IT major. And if you look at the broader trend, the IT stocks have held out well in the mayhem which we saw in the market last week. The quarterly results season should start soon, and Infosys should be posting its results, which we believe should be on the positive side. So to play out the volatility factor and keep the risk under control, we have devised a bull call spread where we are recommending to go for buying a 1940 call option for the 31st October expiry. It's quoting around 39. And simultaneously, you sell a 2000 OTM call, which is quoting at around 21. So the expectation is that Infosys should move up and cross 2000 level in the month of October. In this case, the bull call spread should be giving you a profit of around 8,200, and the risk approximately, or a stop loss which you can have on this strategy, would be around rupees 4,700.
All right, Akshay. The other one, of course, is Tata Steel, which is on your radar. Again, a lot of traction seen in this entire sector of late. Your opinion here?
Yeah, so a lot of traction in the metal space, and the series started off with a very strong momentum in the metal space. It's just that the last 3-4 sessions were a bit offbeat in the metals pack because the Chinese market was closed. Today, the Chinese markets are opening, the stimulus package news, and a lot of the limelight which is around the Chinese market, which you might see a lot of flows getting in, should bode well for the metals pack. So I believe Tata Steel is one of the stocks which has a very excellent technical and derivative structure and promises to cross above 180 levels very soon. So I'm devising a vanilla call buy, which is of the strike 170, which is for the 31st October expiry. Approximately the premiums as it closed on the prior trading session was around 3.5. So you can buy it at current market price on the opening today. The target would be 5.75. Second target can be 6.5, and you can keep a stop loss of 1.75 on this strategy.
All right, that's the other one that we can watch out for, that's Tata Steel, Akshay. But on that note, thanks for joining us and taking us through those two very, very interesting calls as well as option structures that we can deploy in these markets. With that, it's back to you, Tamanna.
All right, thank you for that, Agam. But, banking is going to be in flavor for various reasons. And one big one, of course, is the kind of updates or the number of updates for the second quarter which have come out over the last 2 or 3 days. Harsh is joining us with that list and also telling us which ones seem to have done well and which ones didn't.
Well, yes, Tamanna, good morning. You're looking at IndusInd Bank first off on my list. You're seeing healthy growth, but your loan to deposit ratio has shrunk. So while loan growth has been decently strong, advances grew roughly 13%, 3% on a sequential basis. Deposit growth also up roughly 4% on a sequential basis. So deposits currently outstripping loans just in terms of growth, which is a positive in the current context of things. Both in the possible negative here, if at all any, is the fact that loan growth is lower than what they've guided for. Mind you, IndusInd Bank has guided for an 18 to 23% loan growth in FY25. So that's one possible negative here. But outside of that, healthy set overall. You're seeing Federal Bank as well. Deposit growth has slowed again here. You're seeing a deposit growth of just about 1% on a sequential basis, 16% YOY. You saw 20% growth on Federal Bank at least last 2 quarters. So therefore, this slight moderation of deposit growth likely better to understand from management as to why that's happened. So maybe that's one piece. Advances growth holds up quite well. 19% growth on the advances front. You're seeing 4% growth on a sequential basis where advances are concerned. I'll switch focus to Bandhan Bank actually, because very strong numbers there. Advances growth up 4% sequentially, but what really stood out for me was the deposit growth number, 7% up on a sequential basis. Loan to deposit ratio, which not too many quarters ago was above the 100% mark, has dipped sharply now below the 93% mark, which is the key positive, at least the way I view it. And you're also seeing that advances growth has come back. It's holding up 4% up, 21% up YOY, 4% up sequentially. So that's the possible positive. RBL Bank, again, advances growth slightly on the softer side, 2% growth on the advances front on a sequential basis, 15% up YOY on a relatively smaller book, right? But you're looking at deposit growth, which is really sharp, 7% up on a quarter-on-quarter basis, 20% up on a year-on-year basis. Again, loan to deposit ratio shrinking, which is again a key positive. So some of the smaller banks really eating into deposits, which is clearly positive for their LDR ratios, hopefully allowing them to accelerate loan growth going forward.
Okay, thank you for that. Banks in focus, I would say HDFC Bank definitely in focus, because 2 notes out this morning. One from Nomura that has maintained a neutral and a target of 1,720, mild upside of 3.6%. They say that HDFC Bank clocked healthy deposit growth at 5% Q on Q. The loan to deposit ratio is down 400 basis point Q on Q. The ROE improvement will be a gradual process and will come at the cost of loan growth. Remember, the outlook on HDFC Bank, at least on Friday after those business updates, was not very positive. Morgan Stanley goes on to say that they're maintaining an overweight. Their target price is 1,850. And they say focus remains on profitability over growth. The gross loan to deposit ratio was 100.8% versus 100.5% in the previous quarter, and the average LCR ratio also improved. They are awaiting details on margins, term deposit progression, and asset quality on HDFC Bank. So at least these two are fairly positive, but there's so many more stocks on our radar this morning. Let me just take you through some of them. First, of course, is Titan and Kalyan. Business updates. It's all about business updates in Q2 at this point. Titan and Kalyan have seen strong growth and all their numbers actually above estimates. That's a positive. ITC, NCLT has approved the hotels demerger. It was being expected, but it has now come through. Nazara Tech, it's one of its arms, has got an interim relief. That's good. Bandhan Bank has seen strong Q2 business updates, and realty stocks also will be in focus. Godrej Property and Macrotech, their first half of FY25 has seen strong updates as well. Let's add Gravita India. Board has given a nod to 1,000 crore rupee fundraise. Tata Steel, a strong set of production updates in Q2. GAIL, they've signed an MOU with AM Green, and Emphasis and LTI Mindtree have seen upgrades from JP Morgan coming in, so that looks positive as well. But let's get a quick tech check on what the day is looking like. Kush Bora with us in the studio, Chakri Lokpriya joining in. He's managing partner at Red Strawberry LLP. Welcome to both of you. And Kush, after a very, very tough week, are we set in for respite? Biggest question, are we going to sustain on rise?
So first up, a very good morning, Tamanna. And as it were, today is the 5th day of Navratri, and the color for the day, there are color schemes, right, for every day. And today's color happens to be white.
Okay.
So let's just hope that there is some truce between the bulls and the bears. And after 2 weeks, right, of one massive upswing and the second one massive downswing, I think everyone will perhaps take a day of consolidation, a day of peace, correct? And let's hope that plays out. And the technicals are also suggesting that to some degree. Let me just bring in a couple of data points. On the hourly charts, there is a positive divergence. So even though the Nifty and the Bank Nifty did actually close at the low point of the day, the RSI indicators weren't really as low. There was a minor uptick. So that is suggesting that maybe in the near term, there could be some sort of a technical rebound, that could come in on the indices, both Nifty and Bank Nifty. From the PCR perspective, Bank Nifty has gone into the oversold territory. Nifty is approaching those oversold territories. That is also suggesting that yes, some bit of a respite is possible. But is the downfall over? Is the reversal on cards? I would say it's a little too early to call that, especially given the kind of ferocity with which the markets fell. So I'll give it some time. What played out intraday on Friday might play out on a daily basis on Monday, perhaps today, which is, we had a good start, but then we gave it up and, we ended at the low point of the day. So give it some time, 25,700, 25,800, 24,700, 700 to 800. That's the key support zone to watch for. If that is held, we could see a rebound in the near term. Otherwise, I think this downturn could perhaps accelerate.
Kush, who will lead the rebound today? What sectors will it be, or what stocks?
It will not be surprising to see even banking play, a rebound to some degree.
So bank becomes a good long trade in early minutes, you think? If we get a flat to slightly higher start?
Perhaps, and the only reason I'm a little skeptical is because this is a rebound trade, Samina. We were very, we saw very positive move, on Friday in the first half. But again, with the ferocity with which it gave up, is suggesting that perhaps the pain is not over. So we might want to be a little, we might want to be a little cautious. The only reason I'm a little cautious on the banking names or the banking sector per se is because it's gone into oversold territories. Something like an HDFC Bank is back to the levels from where the rally started, 1600, 1650. So is ICICI Bank. Yeah. And that's why a long trade perhaps makes sense, but you might want to do it in a lesser quantity and with a stop loss in place. With all those caveats, banks could do that. And also FMCG.
What happened on Friday with FMCG?
ITC, even Titan, perhaps, we've had Colgate and Britannia as our top picks, so we still continue to, go with those names. But on the whole, if you see, even Titans had a good update, so, there could be some rebound coming from those corners as well.
What about your top picks this morning, Kush?
Sure. A couple of them we've spoken about, healthcare, or rather we've not spoken, we should have. Healthcare has been, as a broad sector, one of the most favored ones. So the first pick is from that space, which is Strides Pharma. This stock has actually not, if you look at the charts, it doesn't show you any kind of movement that's been happening in the market or any kind of volatility. So Strides Pharma continues to remain a buy. 1485, 1515 are the targets, and 1425 is where you place your stop loss. From the financial space, Sundaram Finance had a good run, saw a bit of profit booking, but then again a rebound on Friday. So Sundaram Finance for targets of 54.40 and 55.50, and a stop loss here is 52.20.
Right. We also have Chakri Lokpriya joining in for a fundamental view on the markets. Chakri, how are you feeling about the markets? It's been on a one-way journey, which is down. Most stocks are available 20 to 30% cheaper than they were about 10 days ago. Are you recommending nibbling on or starting to add to stocks that an investor likes, or would you still wait it out?
I would clearly add because, while the overall market texture, from a fundamental perspective is, the earnings have been, for example, take Titan, very strong numbers, 25% growth. Businesses like Carrot Lane within Titan are growing much faster, close to 30%. So that's good news for some of these consumer discretionary types. Not the regular consumer discretionary, but some of the value-add consumer discretionary. So on the other hand, if you look at banks, if you look at, for instance, Federal Bank, loan deposit ratios, while the overall loan, the loan growth rates are slowing down, the loan deposit ratios are improving. On the other hand, worsening for an HDFC Bank. So I think, we need to be far more, there is enough stocks to look around to buy, but we need to be more careful.
Cautious is what is being recommended both fundamentally and technically. Remember, it was one of the worst weeks the markets have seen since 2022. The breadth of the market was weak. Stocks like HDFC, ICICI and Reliance Industries led the way down. Sectors such as auto, real estate, pharma, banks were down 4 to 6%. One sector that got saved in some sense was the IT pack, which actually relatively outperformed the benchmark, also because it hasn't participated in the September rally. Kush, anything from the IT pack that is looking good? We had Akshay who joined us from GM, and he recommended Infosys as a long trade. Anything that you like? I mean, Wipro was holding out quite well on Friday. I know the selling intensified on these tech stocks, but most of them went on with marginal gains, and we have TCS reporting on Thursday.
So that's the healthy part, which is, IT had a decent run, but it's seen consolidations. It's not cracked. So that's the good side of it. Now, Infosys, is a fair enough setup. Could see an up move. I prefer HCL Tech. We've seen good moves on this one. There's the support of the 20-day moving average that is kicking in. There is some resistance around the 1800 mark, but you take that on a day or rather in a week where the markets have actually tanked quite a bit. So HCL Tech is our preference, and also Persistent Systems. There's been a decent run, but it's seen a sharp run of profit booking. Let the dust settle. I think once that happens, Persistent and HCL will become a good buy. From the large cap names, as I said, we like HCL, and you could also consider Persistent. However, the magnitude of selling on Friday was quite a bit. That's the reason I say let the dust settle on this one, see if that is all absorbed and if the stock gives you an up move, but we like Persistent on dips.
What about Titan? You spoke about briefly, but let's add Titan and Kalyan Jewellers, because business updates have been good. Chakri also talked about them, and we've seen this entire gold stock space run up fair bit. Are you seeing a further up move on Kalyan?
Kalyan is very beautifully set up. In fact, I remember Kalyan and Senco both were our calls in the past month or two. What we are seeing in Kalyan is actually just a round of profit booking. Even in this kind of a dip, it's not actually given up the 20-day moving average, which comes in at around 705. So if there is any kind of further crack, it should be taken as an opportunity. Even at current levels, I think Kalyan is set up for an up move towards 800 or higher levels. Titan 2 was actually doing well, but it's actually given out quite sharply. So today, on the back of the business updates, if there is a gap up and if it is able to sustain above the 3750 mark, I think the up move will resume. But up until then, there could be pressure. On the whole, constructive, but for momentum, you would want 3750 to be taken out convincingly.
You also had a PN Gadkal. I know technically there wouldn't be much on it, but they've reported a solid set of earnings too. But Kush, and I think also Chakri will agree, none of the hedging policy of a lot of these gold companies is that they pretty much hedge most of their exposure, which also means that despite the fact that gold prices moved up, there are no inventory gains that these companies are witnessing. In fact, Chakri, you might want to comment on this. The flip of higher gold prices is that volume sales are not going to be looking good. While the revenue looks healthy, largely because of value sales, volumes are up in the range of 12 to 13%, and we're going into a festive season where higher prices could dent demand. Would you agree with me? Is that a fair sort of way of looking at the sector? Because I know retail investors buy gold stocks to play the gold price increase, but there is no direct impact in many ways.
I mean, it's if you split it two ways, for instance, if you look at jewelry sales, a person has a certain wallet size to be able to spend on the wedding season, which is coming, like some $42 billion is going to be spent in that wedding season. Now, if gold prices are up, as they have been for the about 25% over the last 1 year, their wallet size would remain the same. So what they had planned to spend, they will spend. Yes, they might get fewer pieces of jewelry for that matter. Now, so from that perspective, what the company earns, any jewelry company, would earn that increase, that 25% increase that Titan has shown. And in the case of CaratLane is a good example of, it's not just wedding jewelry, but also, working woman's jewelry. There, the trends are strong. It's 28% growth. So I think overall, and as far as hedging policies are concerned, given the way Gold prices have moved, but rupee has fallen. Companies naturally wouldn't hedge as much, given the inverse correlation between the both.
All right, we'll take a very short break, but we're coming back. We're talking about real estate stocks. We're talking about retail, and we're talking about whether IT could be, along with banks, the winner of the day. All of that and pre-open rates when we return.
Welcome back. You're watching India Market Open. We're gearing up for a bit of a relief trade this morning. After a very, very rough last week, it seems like the start could be in positive territory. 75 points high on implied Nifty. A start around 25,100 is what would please the bulls for now, at least. But of course, the advice is remain cautious, remain on the sidelines, don't go too aggressive. Given the uncertainty around, traders are being recommended to keep positions light. And also the belief is that any sort of rally will be used as a selling opportunity. Well, we've already highlighted the benchmark for a whole bunch of business updates that we've seen. But to add to the stocks to watch list, Anushi is standing by with more on it. Anushi, I believe you've got Macrotech and Godrej both had or reported their best quarter ever in terms of pre-sales.
Hey Samina, yes, so Macrotech and Godrej Properties came out with strong numbers if you have to look at the Q2 numbers. Coming to Macrotech first, now they've reported about a 21% of an increase in their pre-sales number at about 4,290 crore, which is in line with their FY25 guidance of about a 20% growth. Even if you take the whole consolidated H1, for example, they have seen about a 21% of a growth, which is again in line with their FY25 guidance. Collections, they have seen about an 11% growth at 3,070 crore, while the overall first half collections stood at about 5,760 crore. On the business development side, we are seeing them achieving about 75% of their guidance in the first half itself, 16,600 crore as against 21,000 crore that they've guided for the full year. Net debt stood at about 4,920 crore, which is again in their bracket, under the bucket level of 0.5x of net debt to equity level. Now coming to Godrej Properties, while we see a 3% growth in their pre-sales number for Q2, do note the first half numbers wherein they reported about a 89% of a jump. So a lot of push that has come was in the first quarter number that we are seeing in terms of bookings, while collections have seen about a 68% growth in Q2 and 62% growth in H1 respectively. Operating cash flows have been on the stronger side for the companies, 1,800 crore of cash flows, which showcases about a 120% growth, while 200% jump in H1. So with this, the company has achieved 51% of their annual guidance for bookings, 47% of annual guidance for their collections, and 63% annual guidance for business development. and most of these sales that were driven in Q2 were in the MMR and the NCR region. But there's also a note that has come out, Jefferies on India Property, wherein they retain Macrotech and Godrej as their preferred picks and sees Macrotech numbers in line with the company's guidance as we spoke about earlier. While for Godrej, it expects that it can also exceed its 27,000 crore of pre-sales number it is expecting for FY25. Now, overall market conditions, there has been a lot of talks about residential market slowdown that we are seeing, but Jefferies expects that the sales momentum shall remain healthy with the kind of festive demand or launches that will be underway because of the festive season picking up. So sales momentum would be one of the triggers that we should continue to watch out for as we go ahead.
Thank you for that, Anushi. Godrej Properties and Macrotech had their business updates out over the weekend as well. Chakri, real estate has not been a darling at all. Last several sessions, the realty index has been the underperformer. Amongst them, you think Macro and Godrej Properties is worth buying into right now?
Macrotech numbers were good. The company's debt levels are still very, very manageable at about 0.4, 0.5 times. So that gives them adequate room to, continue their expansion of building up for the inventory. And, at some point, RBI will cut rates, whether it's 2 days from now or whether it's next month. It is going to happen. And 90% of all loans are, floating rate loans, and therefore the consumer will benefit. So I think, companies like Macrotech are well positioned, and I think residential real estate still looks strong.
Well, real estate looks strong. Technically, Kush, any sort of real estate stock that you would consider going long on this morning? Macrotech and Godrej reported very strong business updates.
So not so much on Macrotech, but Godrej Properties was anyway close to its support zone of 28.50, 28.80. So if it does sort of hold on, and it looks like that it could open in the positive, then perhaps you could see a further up move, and that could be close to 3060 kind of levels. If that is taken out, you're looking at a 3200 also. These are positional levels. So from a risk reward standpoint, Godrej is looking attractive. Not per se a developer, but from the real estate space, Anant Raj has been one of our top picks, continues to remain so. Hasn't really seen too much of a dent, despite the kind of the moves that the market has seen.
Okay, let's look at auto numbers have also come in, and these are FADA numbers. That means this is retail auto numbers which have come in, which is frankly not looking too great. Car sales are down 18%, nearly 19% year on year. Two-wheeler sales down 8.5%. Three-wheeler sales are the only sort of reprieve there, up 0.66%, less than a percent up year on year, and CV sales are also down 10.5%. In fact, car inventory has climbed to an all-time high due to aggressive dispatches of car makers ahead of festive season, which is to be expected to some extent. Autos, the other big pain point in Friday's trade, Chakri. Do you expect any kind of a reprieve there, or are you expecting tougher times now for the auto pack, and which one among them looks the weakest?
I think amongst them, the weakest is the commercial vehicle sales, because, that corporate capex needs to pick up for CV sales to pick up. That is not happening anytime soon. So I think the safest play among them is still the two-wheelers, whether it's TVS Motors, Bajaj. They are still showing the volume growth, and therefore I think two-wheelers better than CVs.
Which two-wheeler would you go long on then, Chakri? Ahead of earnings, what is it you're picking up?
Yeah, it would be TVS Motors as well as Bajaj Auto. And these companies are gaining market share in both their traditional as well as in their EV. They have the distribution network, which a company like Ola does not have. Over time, built up decades of thing, which they're using to service their EV as well. And again, interest rates is a common theme for all rate sensitives, whether it's real estate or autos, which will benefit in the coming months.
Eris Life Science, I've been hearing very good things about the company, and fundamentally also post its recent acquisitions. The idea is in this generic business, the margins are so phenomenal that they'll manage to sail through and in terms of repaying debt. Stock has been down for the last 1 month. Does it look like a good trade in the pharma pack, you think? I know you highlighted a few more, but I think this one stands out.
In fact, why not dial the clock back maybe a couple of months, and the stock was consolidating around the 1,000 mark. and it's had a stellar run. So it did pop up on some of our lists that we track and some of the screeners that we track. It's had a very good run from that 1,000 all the way up until 1,500 mark. And then what we're seeing now is basically a lot of consolidation, a lot of profit booking going around. On the whole, the setup is very nice. Last week, the stock had a very huge surge in volumes, on a couple of days when the stock was up, which is suggesting that after the fall, there is this delivery buying happening in the stock. I would remain constructive on, Eris Life Sciences. That's actually a very good find. Positionally, 1280 is where you place your stop loss. On the upside, you could look at 1500, which was the recent high, and once that is taken out, 1650 as well. More of a positional play, but a good find.
All right, your pre-open session is not looking too bad so far after a very, very tough week. So that's some good news. In early trade, your financials doing okay. Macro tech is doing well. All news flow, which is pushing it. Look at Titan, about 2.5% up. Rahul Arora is joining us now, CEO Nirmal Bang, Institutional Equities. Rahul, great to have you on the show. And, we were keen to talk to you because no one knew what was going to happen over the weekend. It's one of those situations that you have 2 days of markets shut and anything can happen considering what's happening in the world right now. Thankfully, it's turning out to be perhaps a decent morning. What's the play? What's the strategy here? Are the clouds behind us, or there is a lot to worry about right now in terms of FI outflows, Q2 numbers? What has you worried, if anything?
Morning, Tamanna. Thank you for having me on the show. So I think, Tamanna, broadly, it's a very welcome correction. I think, it was long overdue. I don't even know if you can call it a correction because, when the pandemic started, I remember the Nifty had fallen down from about 12,500 to 7,500. And then from there, it's pretty much been a one-way rally to, 26,000. So, the new investors that have come into the market, say, post the lockdown, really haven't seen much of a correction. That being said, I think while valuations have reset a little bit in certain excessive pockets on the market, it's not meaningful enough for me to make a very convincing buy. I think, maybe another 10-15% fall in some of the frontline stocks or rather the overvalued stocks would be all right, which also implies that if the Nifty itself was to fall another 5-10% from here, it would be a little more comforting. Liquidity, as we've discussed often on your show, Tamanna, is pretty much turning out to be a bane of valuations. You're either having to stretch valuation multiples or stretch your time horizons. But, let's see how the markets pan out today. There's been a spike in crude of almost about $8 or $9 in the last 10 days. It dropped down to about 65 and now it's almost 73, 74 or maybe even inching higher as we speak. But all things considered, I think the one thing to test, Tamanna, would be how liquidity reacts to this. And if liquidity does not react in a very adverse manner, I think all corrections will be very shallow-lived in this market.
Rahul, hi, it's also Samina joining in. And for some reason, while FIs have not really been overweight India in 2024, everyone and anyone seems so concerned with the fact that FIs are buying China now. I mean, they were never aggressive on India any which ways, right? We've talked about and harped about the fact that our market is now a DII market. Should we be worried?
Well, I think, anything incremental always helps, Tamanna. And as you very rightly pointed out, I think it's been such a DI-centric market that, whatever little you saw in terms of an FI top-up over the last month or so has only aided the Nifty in its journey to about 26,000 and beyond. Now, China is a bit of a concern because, in less than a month, the US also goes into elections. And I think it's, whatever debates we've seen from the two presidential or vice presidential candidates, it's been more rhetoric than actual roadmaps in terms of how they're going to tackle the deficit and what their policies are going to be. So I think as we enter 2025, we are going to compete for capital with the US and China. And that's not going to make it very easy. And which is why I went back to the previous point, whether this liquidity can actually sustain in the wake of a correction. Because I think if you keep getting 25,000 crores of SIP money every month, I think we should be okay. Now, that is, of course, goes back to the earlier point I was making. It's going to make valuations unreasonable for a very sustained period of time. But, as somebody, very famous once said, markets can remain irrational longer than you can remain solvent. But I think anything incremental is all right, but I wouldn't be too perturbed with FI monies going here or there. My bigger concern would be if the rate of SIP inflows was to drop down to, say, 18,000 crores. That would be the real test for the Indian markets, in my opinion, rather than tracking FI flows as closely as probably people in China would be.
Fair Fair enough, fair point. And then, of course, what the quarterly numbers looks like also becomes important. But one segment which is in focus is IT. And very quickly, we're going to get Harsh in. He talks about the top brokerage report at this point in the morning. Harsh, what do you have on your list today?
Very interesting note coming in from JP Morgan. They've in fact upgraded LTI, Mindtree and Emphasis. They believe BFSI is turning a corner in terms of segment. And these two players have a large chunk of their revenue coming from BFSI. To be absolutely precise, 35% exposure is what LTI Mindtree has to BFSI. And Emphasis has roughly 59% exposure to BFSI. BFSI is banking, financial services and insurance. That's the space which likely is where tech spends will start to inch higher, and these two players are poised to benefit. They believe that acceleration is going to be driven by tech spend pickup. US bank earnings expected to improve in the first half of calendar year 2025, and that could drive up tech spends is what JP Morgan is really breaking down. They have a 13% upside on an LTI Mindtree, target price 6,900. They have a 19% upside on Emphasis, target price 3,400.
Okay, one more stock to look at is Keynes Tech. Nomura has a buy on it with a target price of 5,969. So the reason is they're acquiring 100% stake in this company called Iskarmeco. I hope I'm saying it correctly. It's present across Middle East and Europe. And there is a Jefferies note also which has not such an exciting view on it, downside of 13%. But Rahul, I want to quickly get your view on IT. Is IT going to be the positive surprise of this result season?
Well, I think it's been an overweight sector for most institutional investors, to be very honest. I think, the last 6 months, if you've seen, let's say going back to pre the general elections as well, I think the trade probably started somewhere around March, April, where people sort of started moving out into banks and IT and FMCG. I think, specifically for TCS, I mean, our own expectations, which is the bellwether that comes out later this week, is about a 1.1% kind of growth that we're looking at on the top line with about a 10 basis point improvement in margins. But valuations are not entirely cheap in the sector. I was just listening to one of your colleagues talking about an upgrade from one of my competitors on LTI Mindtree. That's been our top pick for quite some time now, I think, since we initiated a couple of months back, reinitiated rather, after a change of analyst. But I think, the way to look at IT services, frontline IT, and I'm not talking about ER and DS players like a Persistent, KPIT, Coforge, etc., or other kind of niche IT players, but I think the more mature IT services players and FMCG players in India, the way to look at it is an average 5% kind of growth in terms of a regular year. In bad years, it'll probably drop down to between 1 to 3%. In good years, it'll probably head up to about 8-9%. But these are never going to be double-digit compounders on the top line, is my sense, because they're very, very saturated. Now, the question is, for those kind of growth rates, what valuations you want to pay? The way we valued these companies 2 months back when we reinitiated was we did anywhere between 0.5 to 1 standard deviation above the 3-year mean. And that gave us about 15 to 20% kind of upsides on the stocks that we were a buy on, which was basically pretty much the frontline IT pack. I'd say maybe if, the IT index weight is about 12%, I'd say about 50 to 100 basis points overweight at this point may not be a bad strategy. And I think the stocks to probably be in over there would be, I'd say LTI, Mindtree, TCS and Infy from the large caps. I think you could look at a Coforge from the mid caps and Birlasoft from the small cap space. So you may not get the returns that you've got over the last 6-8 months, but I think the way to look at least this quarter's results is probably a 1 to 1.5, 2% kind of top line growth, with margins by and large for most of the frontline IT companies expanding by between 10 to 20 basis points. So not very gung-ho, but just marginally overweight would be my view.
And one shouldn't complain, Rahul. We've borrowed returns from the future. We've had a phenomenal run on the markets post-COVID-19. There have been, of course, smaller cycles of correction, but the fact remains that this sort of euphoric bull run can only continue that much. But, of course, this morning seems like there could be some respite. We're coming out of one of the worst weeks since 2022 for the Nifty. And interestingly, while the recent rally in the last few years has been led by broader markets, the decline that we saw over the last 5 days was led by the frontline names only because they were the last sort of sectors or stocks to join the recent gain. Well, today it seems like we could have respite. There is a little bit of an upside challenge, but the markets, remember, are going to remain cautious. Traders are still being advised to take keep positions light, and of course, be cautious while making and initiating new fresh trades. That's the Nifty at 25,100. Remember, on Friday we intermittently dropped below 25,000, but managed to close above those levels. So that becomes very important for the bulls in today's day of trade. The start is not bad. It's up 112 points. The Nifty 50 at 25,125. Bank Nifty, that's given up about 3,000 points since its rally on September, which began on the 11th of September, is added a small portion of gains this morning, 250 points on Bank Nifty. Remember, last week the losses were led by stocks like HDFC Bank, ICICI and Reliance Industries. Sectorally as well, auto, real estate, banks, pharma sold off quite sharply. IT was okay because they didn't really gain too substantially in September, and also their earnings reporting starts with TCS reporting on Thursday. IT, though, is a top gainer this morning as expected, up about 1% as we see. Consumption as well should do okay in today's day of trade. A quick check on how the Nifty 50 is doing and how the breadth of the market is trading. Of the Nifty 50 counters, it seems like the bias for a change. This is a rather pleasant morning in terms of the sectoral picture. The WIX is down marginally. Every sector is trading higher. So that is some relief coming in for the street. IT is leading. Media is doing okay. Banks are holding up. You also got pharma that's marginally high. Marginal gains, but nevertheless in positive territory this morning. On the Nifty 50, it will be the stocks like Wipro, TCS, Infosys, and that's exactly what it is. Wipro is up about 1% and a third. Remember, Wipro has been a lagging stock in the IT pack for the last 6 to 8 months. Fundamentally, there have been concerns, and what we'd seen is somewhere around September is when it started participating just a little bit. Then there came a sell round where last week it gave up most of its gains, but technically looking strong, and Wipro hence is reacting well. ITC was par for the course, where there was an NCLT approval on the demerger. The stock is up about 1%. But remember, ITC sold off on Friday for no apparent reason. So what you're seeing this morning is buying emerging in a bounce back after the sell-off that we saw. HCL Tech Mines are looking good. ICICI Bank, no significant gains after that big sell-off last week. But I'd imagine that it started off positive. It will continue to build on the gains as long as the market sentiment looks okay this morning. On the sell side, Titan is looking bad. And this is surprising because their business update wasn't too bad. We'll, of course, try and understand from Kush if he still likes the stock. L&T, Maruti, HDFC Bank, 6 straight day running, the stock looks weak. So, Tamanna, not a bad morning. As expected, Wipro and ITC are leading the pack.
Yeah, and you're seeing the rest of the consumption story is pretty weak. HUL, Nestle, Britannia, all of them hurting. Titan, of course, is the big surprise over there. Let's look at what the broader markets are doing as well. Is this Nifty recovery or all round? And not half bad. The Nifty mid-cap about 0.5% up right now, like the top line indices as well. The small cap also 0.5% out. So you have now an overall recovery. Is this going to be a sell on rise is really the question. Let's look at specific stocks because business updates has dominated the news flow last couple of days, and that's the kind of reaction you're expected to see as well. So coming in first, Macrotech and Godrej Properties. They had decent numbers. In fact, for Godrej Properties, highest ever in first half of this year. Good sales numbers. Macrotech also doing very well, 4% and 2.5% up in trade. Titan and Kalyan. Titan is a surprise because business updates were actually good. Kalyan also looking down. Is there a concern that higher gold prices actually mean slower offtake? Perhaps that's the reason you're seeing both of them in the red. BSE, we talked about this as a stock definitely to watch. The rally is continuing this morning as well after a run up 45% in the last 1 month. Stock is up 1.5% today as well. Geo Financial, we talked about this. They have a SEBI nod for a proposed mutual fund with BlackRock, 2% up on the stock. More business updates really dominating, but in the banking space this time, let's look at Bandhan, let's look at Federal, let's look at IndusInd. Federal in the negative as was expected. Numbers were not that great. IndusInd is flat, but Bandhan, and this was on our stocks to watch list this morning as well, is roaring about 2.5% up. Info Edge is also interesting to see. Their business updates came in a short while ago, but the street has not taken to it too kindly. That stock nearly 1% down. So a mixed bag there. A lot of the numbers that are dominating, Samina, seem to be the first inkling of what Q2 will look like, and that's going to be the conversation starter.
Indeed, in fact, that's what we have in terms of some of the stock movers as well in today's day of trade. PN Gadgil reported numbers, a good set of earnings. Volume growth came in at 15%, even though the frontline number shows the 35% growth. A chunk of that was led by higher prices in gold. So value growth is what we saw. Avenue Supermart is down about 2%, again back on business updates. A whole host of financials are also going to be a talking point on back of their reporting ahead of the quarter. Macrotech and Godrej reported their best quarter in terms of business updates. So both the stock also will be seeing some movement, the gain of 3% each. KRN is up, is down and out. A 3% cut is what we have. So all in all, it's a somber market. Be interesting to see how things play out. Varun Beverages is seeing a 3% cut too. You've also had a little bit of movement on a few other names in the broader markets. But coming back to you, Rahul, and this is Samina joining in. Do you expect any surprises from the monetary policy on Wednesday?
Not really, Samina. I think, the Fed has sort of laid out its path on where it's going to be this year and next year. In India, we actually don't see a very, how should I put it, a very deep rate cut cycle. It's probably going to be a very shallow one. I think 25 basis points at best. And I think that too, if it comes through, will probably be in the December of the Fed policy. I don't think it's required right now. And I don't even think the Reserve Bank of India needs to do it right now. I think obviously there's a new monetary policy committee in place, and it'll be interesting to see, what their views are when the MPC minutes come out. But look, we had actually done a study, and my economist had actually put out a report some time back, where she studied US recessions that were essentially led by the US Fed when they were tightening interest rates. And I think right from Paul Volcker's time till now, if you see, these recessions typically last 2 to 3 quarters. So they're not very deep. So maybe the Fed has over sort of guided for its rate cuts as well. They may not follow through with such aggression, I think, between now and the end of 2025. But particularly in India, our base case is that, more than a 25 basis point rate cut in this fiscal year, not calendar, is not really warranted. And that too, if it comes, may probably come through only in the December of the Fed policy.
Rahul, just want to get your take on what's happening with your FMCG majors and the consumption space. I mean, Titan was a bit of a surprise, Titan, Kalyan, but even the pain we're seeing in an HUL, Nestle, ITC is an outlier for today. Is there a concern about the kind of demand that we're going to see going forward?
So I think, Tamanna, this much talked about K-shaped recovery has only accentuated over the last 2 or 3 years. And I think the disparity between consumer discretionary and consumer staples has been quite stark. I think the trade that you saw the last 6 months that we were talking about before the markets opened was probably a time and price correction that you saw in consumer staples. But I think in terms of company performances, if you see, consumer discretionary is actually doing far better. And that's not just restricted to jewelry, as you were discussing Titan and Kalyan before the markets opened. I mean, just look at hotels. They've not dropped ARRs at all in the second quarter. And now you're getting into the wedding season and the festive season in the October, November, December quarter. So it's going to be another strong quarter for them there. I think Alcobev is doing really well. I think, if you look at consumer as a basket over the last 12 to 15 months, whether it's a United Breweries, United Spirits, Radico, Global, Sula Wines, they've all had a remarkable run. Stocks are between 70 to 100%. So I think consumer discretionary continues to do well. Probably the softest piece of this puzzle has been the quick service restaurants. But I think even there, the stocks like Jubilant Foodworks that have seen time and price corrections are starting to sort of, look up. We ourselves did some channel checks on the ground for quick service restaurants over the last 1 month, and we found out that the trends month on month are actually improving. And you may actually land up in a situation where some of these, if not all, may actually land up giving you low single-digit positive same-store sales growth for this quarter. So I think if you're looking at consumer as a whole, I'd still be relatively more positive on consumer discretionary names like Alcobev, selectively QSR, and leaders in jewelry and hotels, of course, as opposed to consumer staples. That rally lasted about 6 months, but I don't think there's too much juice left there. That being said, if you do get a correction in names like, say, a Britannia or a Tata Consumer or a Dabur, we would look at buying these names at about 10, 15, 20% kind of dips. But there again, valuations are not too cheap at this point in time. Therefore, I'd wait for a little bit of a correction because like I said earlier, I don't think these are companies that are going to compound top line at 10%. whereas discretionaries would be growing at 15-20%. So I'd be, even though I'm paying a little bit more for consumer discretionary, I'd be, sleeping a little more at peace, knowing that growth is there to back it.
And it seems like at least we've got eyes on the ground when it comes to local consumption names. Rahul, we've seen what China has done, and we've seen how the metal index has responded to that. The Nifty metal index is up over 10%, having its best sort of month since May. What are the bets? Are you buying steel? Are you buying aluminium? What are the stocks you would seem to believe that have a good risk reward even after the recent rally that they've seen?
Look, I think there's a lot happening in that sector. I think, one is, of course, as you rightly said, if the metals index and if China continues to be a huge producer and consumer of commodities, we are price takers. So from a macro standpoint, going back to your earlier question on the MPC, this could actually end up being inflationary for us if we have to import commodities and commodity prices are going up. That being said, I think for companies and sectors in India that have pricing power and are able to use that to their advantage, we'd be, more comfortable looking at those kind of stocks and sectors. Now, just to put it into perspective, price hikes in India are not a very sustainable thing. And we've seen that in the case of cement as well. There are always price hikes and rollbacks. But I think all things said and done, I think steel is not a bad place to be, considering all that's happening in India with respect to capex and the kind of demand if we're talking about with respect to infrastructure, with road sports and all of that. I think steel may not be a bad place to be. I think Tata Steel has tried to do what it's doing with in terms of deleveraging its balance sheet over a period of time. Of course, the debt number is still very, very high, but they've been trying to do what they can. But I think that this is probably not a bad pocket of the market to be playing in. So if I was to be on the commodity side, I'd be more on the ferrous side at this point in time. But like I said, I think from a macro standpoint, having commodity prices under control actually helps us, because so many of our sectors, going back to cement, are consumers of pet coke, coking coal. So the lower these prices stay, they're actually better. But like you said, the stimulus, if it revives China's infrastructure building in a material way, then we could have a slight problem. But I think in India, on a relative basis, I'd be more inclined towards ferrous than non-ferrous at this point.
Are you staying away from banks and auto right now? Are you seeing opportunity here?
No, I think banks is that one elephant in the room that wants to dance, but is not getting a chance to dance, right? I think most of the private sector banks, Tamanna, I think if you look at the valuations from IndusInd Bank to say ICICI Bank, most of these guys, and if you throw an SBI in the middle as well, they're all going at 1.5 to 2.5 times price to book. I don't think that's demanding at all by any stretch. I think at the peak, these banks have traded anywhere, barring SBI, of course, they've traded anywhere between 2 to 4.5 times. So is there room for these, banks to re-rate on the way up? Of course there is. But I think what's happening in the system is deposit mobilization is still a challenge. I think, you're still seeing banks on a case-to-case basis that are actually raising deposit rates, even though we've been discussing rate cuts.
Rahul, if you're talking about the elephant that is not able to dance, does HDFC Bank have 2 left feet?
Well, it's our biggest buy call, and we have almost, a 30-35% upside on that name. And I think ever since the merger, obviously there have been operational, synergies and things like that have played themselves out, but nothing that HDFC Bank had not guided for during its process. Maybe some of it was a little more accentuated than analysts expected. But, at what? It's been trading at between 2.5 times for some time right now. I think it's still a bank that's going to grow at 20% on a blended basis for the foreseeable future. If you just start seeing, structural evidence of, probably a 20% kind of growth along with margin expansion, I think, the trade will probably shift back. I think people want to own this name. It's been a darling of the market. And like I said, both HDFC Bank or HDFC Life Insurance, which has traded as much as 4.5 times price to embedded value at its peak, are to us screening buys right now. It's just a question of under ownership and when the price, when performance returns to match market expectations. I mean, you were discussing DMart a few minutes ago, Titan. These stocks are priced to perfection. Asian Paints, you really don't have too much room for error. HDFC Bank was that kind of a stock when it was trading at 4.5 times. But at 2.5 times price to book, if you're going to have an entity that's growing at 2% or 20% with margin expansion and not too many concerns on asset quality, I think it's just a matter of time before money finds itself, not just to HDFC Bank, but I think the sector at large. I think there is a case for about a 20-25% valuation reset. It's just a matter of time before it happens. And I think, the problem with this, Samina, is when it'll happen so soon. So if you're not owning these names at that point, you'll probably miss the rally. So I'd say it's better to be a little earlier in banks, because these are very high quality franchises, then try and catch the up move, because these stocks will probably move 20% in a week, 10 days. And if you're not owning them, you'll probably feel left out. So from our vantage point, we'd probably be ascribing an overweight on this sector, not just large caps. You were discussing Federal Bank, that looks like an interesting one. We'd be buyer on dips. And even some of the housing finance companies, gold finance, I think we like something like Muthoot. We've recently initiated a couple of months back on Housing Urban Development Corporation. So there are lots of these names in the entire BFSI sector that look interesting, where valuations are not demanding. And that, I think, will be probably our number one overweight sector in the market as of today.
Thank you, Rahul. Good talking to you. Have a good week, and we will see you soon. Kush, very quickly, it's 9:30. The markets are settling, and they're still trading with a positive bias. Update on ITC, because that was a stock we'd like to talk about. Would you look to adding fresh positions to ITC? And also, you'd recommend a Titan before the markets open. It's somber. Still a good buying, still a good long trade, you think?
So ITC is still a buy. There's this consolidation zone around the 500 mark, 510 mark. It's still respecting that. So you could take on. But again, ITC is not typically a trader counter, so you'd want to hold on to that one for some time. And Titan, yes, because of the business update and the kind of setup that we'd seen before the last week, debacle. We did suggest that the momentum will come in after 37.50, and guess what the day high is, 37.48. So you might want to be a little cautious on that one. Also, the 200-day moving average support is at 35.50, very close to that. So you might want to just perhaps hold on, any fresh buys that, despite the positive updates, the stock's not done well. So 35.50 is a crucial level to watch for. And just a quick word on Strides Pharma, the stock that we had discussed as an opening trade. 14.85 was the first target. That's been hit. Now you can gun for 15.15, the second target. So Strides Pharma doing well, could continue to do well for levels of 15.15.
Thank you so much, Kush, for joining in today. And it's been an exciting morning, at least a positive morning after quite a battering all of last week. We've started off fairly decently and holding up as well. But we're speaking now with Srinivas Kulkarni. He's CFO of Cyient DLM, and they have some exciting news. In fact, in an exclusive conversation with us right now, Mr. Kulkarni. So thank you so much for joining us here on NDTV Profit. Let's talk about your strategic acquisition of a US-based EMS manufacturer, Altec Electronics. Let's start there. Tell us about the acquisition and what you hope Altec is going to add to you.
Good morning, and thank you for having me on your show. We've acquired a company called Altec Electronics. This is an electronic manufacturing services company that's located in a place called Torrington. It's a 2-hour drive from New York in Connecticut. It's also in similar business. They do printed circuit board and assembly, cable, wire harness, box builds, but their focus is mostly on industrial and medical customers. In fact, 90% plus of their business comes from these two sectors, which actually blends well with what we have. We have a focus on aerospace and defense, so this diversifies our portfolio quite well. They have about 200 employees, and they have about 80,000 square feet of manufacturing space. And they are also ITAR certified. ITAR is the International Traffic in Arms regulations that actually allows some of the work that we can do in defense now, which was earlier a problem because we did not have presence in the United States. So we are very excited about this acquisition and what it brings to us.
What are the financial details, Mr. Kulkarni? What is the size of the acquisition? And, how are you sort of going about it financially?
From their financials perspective, they did a revenue of $37.2 million in calendar year 2023 with about 10.5% EBITDA. We are paying a multiple of six times on their EBITDA upfront, which is $23.4 million. And there's also an earnout which is linked to performance of another $5.8 million. So the transaction would effectively land us at 7.5 times the multiple if you pay the full earnout. We are funding the upfront consideration through our own proceeds. I think we had raised some funds during the IPO for M&A. So 50% of that comes from there, and the balance 50% comes through debt.
Okay, and what is sort of the estimate or the the back of the envelope workings of the contribution Altec is going to have to revenues? When does that start flowing in from?
Analyst space, they'll add $40 plus million with a 10% EBITDA. So they'll add 4 million to EBITDA and 40 million to the top line. And of course, there are synergies and growths which are on top of that. I think there are a number of opportunities where we can take their offerings to our clients and vice versa. So yeah, I mean, it's an EPS accretive deal right from the word go for us. So we are quite excited about the financial prospects as well.
Hi, Mr. Kulkarni. It's also Samina joining in. Now, you've talked about how this gives you a presence in a vertical and a geography that you didn't have a significant presence in. And of course, it will be revenue accretive sooner than you know. What I want to understand from you is, does this acquisition also give you opportunities to cross-sell? And if yes, what will that do in terms of growth numbers, say, for FY25?
It's hard to peg a number, though. There are definitely cross-selling opportunities, right? I think a number of our clients request our presence. See, location advantages is huge for this company. They are placed in Connecticut, which I think top 15 manufacturers, OEMs are present there. This is also quite close to the medical hub, which is the Massachusetts, right? And this company has 60% of their business coming from industrial and about 35% coming from medical. So these are two focus areas for us, right? So there are plenty of opportunities to cross-sell, as well as bring in some of their offerings to our current existing clients as well.
Right. Sorry, sir, I'm not sure whether we caught you, but can you help us understand when will this turn revenue accretive? Will we see the impact of this acquisition on your earnings from the next quarter onward? And also what I want to understand is a timeline for complete integration, because until that happens, things could be a little up and down, at least internally for the company.
Yeah, so we have closed the transaction on 4th of October. So this is going to show the impact from this current quarter itself. There were a couple of approvals we required in terms of the CFIUS, which is the Committee for the Foreign Investments in the United States. We've already obtained that. So this deal is closed. So we will see accretion right from the word go. Of course, in the first quarter there will be one-off M&A costs in terms of the transaction-related fees. Keeping that aside, it is an accretive deal to us right from the word go. Integration will pan around about 6 to 8 months. I think we have a very robust integration plan that we have put in place. Yes, so for this financial year, let's put it this way, that we will settle down on this acquisition. And from the next financial year, we can start seeing the full benefits of it.
So what does it do to your blended margins? How much improvement can we expect on your margins for Cyient DLM post this merger?
It will be marginally accretive. Yeah, it will be marginally accretive. We are also operating around the similar number in terms of the EBITDA. We are around 9.5% right now. This acquisition is around 10 to 10.5%. So it will be moderately accretive, but not in a substantial way, because their financial footprint is very similar to what we have in terms of margins and profits.
Are there more acquisitions on the anvil? Can you just give us a sense of any inorganic growth plans going ahead, Mr. Kulkarni, or are you hunting for more opportunities like this?
Absolutely. I think inorganic activity continues to be a very key part of our strategy in terms of expansion and footprint. Right now, there is nothing in the horizon that can close immediately. So we are but in early stages of conversations with a few companies.
Srinivas, your top line growth has been in the range of 15-16%. At least that's what we've seen so far. Now, with this acquisition and more around the corner, and of course, the completion of this over the next 6 months, what is the sort of growth that you're gunning for in terms of top line?
I think this acquisition will add further growth on top of the existing organic growth we see. Just one correction there. I think our year-on-year growth has been around 30% actually on the top line. So this will be on top of that number.
So 30% plus how much? How much more would you grow at in that sense?
So I mean, last year we did a revenue of about 143 million, and this acquisition on an annualized basis adds is about 40 million. So we can do the math. So.
Any sort of risk associated with this acquisition in your mind, Srinivas?
There are the usual business risks of a supply chain disruption due to some global event. There are always risks with respect to not being able to scale to the demand that we see in the market today, right? But barring that, there is nothing unusual or a specific risk for this entity.
I know you can't talk about your Q2 numbers, of course. We are in that period before you declare your numbers. But just to get a sense, Mr. Srinivas, whether this has been a good quarter, what is kind of the visibility for H1 looking like?
Look, I think we are in a quiet period, so I'd really not say anything. I think it's overall I'll say broadly that the tailwinds continue in this industry, and we are quite confident of our growth and outlook.
Srinivas, just talking about more broader sort of aspect, and I know this is going beyond earnings. Any sort of significant conversations that are underway? I mean, your order book is something that we will watch out and talk about in more detail when you report numbers. But any sort of big deals that we can expect that you're in conversation with that could, culminate over the next few months?
I think there are several large deals in the pipeline with our existing clients, and we are very hopeful of converting a few of those quite quickly, and we will announce them as and when they get closed. A lot of these projects and the deals will be of long-term in nature, right? They'll all span over 10, 15 years. So we might not see an immediate jump in the order book, because order book is a more tangible number based on the purchase orders we get. But the deals wins would be there, and that augurs well for the long-term outlook of the company.
All right. Thank you so much for speaking with us. That's the management of Cyient DLM speaking exclusively to NDTV Profit. Big acquisition there on the anvil. And of course, they're talking about how this will become revenue accretive. It's already been signed on. So those benefits start flowing pretty much from this quarter. Now, the other big story is that NSE has received a major boost to its bid to list on the stock exchanges, as SEBI on Friday said that the NSE has settled a case involving alleged violations in trading access points by paying a settlement amount of 643 crore rupees. Why is this important, and why is this one big hurdle out of the way for NSE to list? Charu's joining in with more.
Hi Tamanna. So as you said, on Friday the market regulator SEBI came out with an order allowing the National Stock Exchange to settle with its issues that were related to tap access point. Now, this was a system that was brought in 2008, and it allowed the members of the National Stock Exchange to basically compute what kind of transaction fees is to be levied. Now, this allegation about not having remedial policies in place to prevent its misuse is out of the court. That means no regulatory action is going to be taken against the National Stock Exchange in this regard. Apart from this, the co-location issue that has been in action since 2019, which was a biggest roadblock for NSE IPO, has also been dismissed without any direction because of the lack of evidence. And the exchange was also recently allowed to file a fresh NOC. And there was also a case in Delhi High Court asking the market regulator to expedite the process for NSE IPO, which is now listed for December. But before that, all the processes are already falling in place. So all the regulatory issues and other issues are basically disappearing one by one, and all the hurdles are also going away, which seems to be a good news for National Stock Exchange's IPO approval from SEBI.
All right. Thank you for that, Charu. So that's, of course, the big one, right? When does the NSE IPO come into place? And look at BSE this morning. BSE is something that we've been tracking as well. A couple of news points on the weekend, and BSE has been rip-roaring, but off its highs now. In fact, markets also off its highs. A bit of pressure coming in. The Nifty still in positive territory, but definitely off the day's highs. The big story, though, this morning is the Nifty IT. Look at what's happening with the Nifty IT. Positive global cues contributing to that, no doubt, but emphasis is the rock star of the IT pack this morning. About 3.5%, nearly 4% up now. LTI Mindtree, persistent. So you have the mid-cap IT majors coming in and really boosting IT companies. But apart from IT, you're not seeing that much of a move in the market. So we've started off positive, no doubt, but have not managed to hold on. Pharma is still doing okay. In terms of Nifty, I think stocks like Titan, HUL, Nestle, all really suffering a fair bit. Even in the broader markets, Samina, I think the positive story is now becoming a little more far and few between.
I think the bread's deteriorated quite a bit in the last half an hour of trade. I mean, look at the Nifty 50, right? 50% of the stocks are now trading lower. But like we said, the action in the broader markets is also very interesting. Vodafone Idea, take a look at how the stock is doing. I think it's down 6% from when I last checked. Vodafone Idea is trading with a cut of 6%. Bombay Burma is down 5.5%. Jubilant Jubilee, Rail Vikas, Triveni, fertilizer stocks are all down in the range of 3 to 4%. On the upside, I don't know what's going on in Senco, but the stock is on a breakout, 5.5% up move on Senco. And all this when they have seen an impact and do not expect a very euphoric festive season going ahead on back of higher gold prices. But Senco, of course, trading firm with a good move, 3.5% high on Senco is what we have. AstraZeneca, again, I'm not sure what the news trigger point was here, but the stock is one of the best performing pharma names in trade as we see it. An 8% up move is what we have. We were talking about gold companies and how Senco has been performing well. I caught up with Saurabh Gadgil of PN Gadgil. Remember, the company listed only a few weeks ago have created enormous and significant investor wealth. This is the first time they've reported their numbers post listing. In fact, listen into what Saurabh has to say as we talk about the earnings, the outlook for festive season, and of course, what sort of volume growth he's targeting in FY25.
It's the first earnings announcement, so it's really special, and it's been a good quarter in terms of revenue, in terms of profitability, in terms of e-commerce. There's been growth on all parameters. Just to start, our revenues increased by 33% in Q1 of FY25 as compared to FY24. FY24, we had a top line of 1,256 crores, which increased to 1,670 crores approximately. So that's a 34% rise in the top line. When it comes to profitability, the PAT, there was a huge significant jump of almost 60%. From a PAT of 22 crores for FY24 Q1, we have moved to 35 crores PAT for FY25 Q1. So that's a significant increase. We've added 3 stores in Q1 of FY25. When it comes to e-com, we have shown a significant increase of 120% in the top line, from 13 crores to almost 30 crores. So it's been a good quarter. It's been a significant improvement on all parameters as far as Q1 is concerned.
Right. Saurabh, your growth has been strong. You're growing at 33%, which is much higher than most of your industry peers. Is this sustainable going ahead? Can you give me a sense of what is the kind of expectation we can have in terms of growth trajectory for the next couple of quarters for the rest of FY25?
We have been growing a little more than industry, and we believe that that's because of our effort towards, store efficiencies, effort towards getting more share from competition. For the next couple of quarters, we feel that a 20-25% increase is sustainable, and we are confident that we'll be able to achieve those figures.
Saurabh, break down your top line for me, right? What are the key revenue drivers? So has it been gold? Has it been diamonds? Has it been precious gems? What is the revenue contribution from various product offerings?
Primarily, gold has been the major component of it. Our studded ratio is around 10%, and the balance is gold with a portion of around 3-4% of silver. So 85% would be coming from gold. 3-4% is from silver, and the balance 10% is from diamond and studded stone.
Right. So we're going into the festive season at a time when there's a little bit of nervousness, jitters around what's happening globally. So there's some amount of geopolitical stress, which has meant that gold prices have been on the rise in the last few months. In fact, year to date, gold has been an outperforming asset class. Now, with the kind of elevated prices we are seeing in gold, do you feel like this could impact the demand, the festive demand this year?
I believe that gold is looked at not by consumers as a short-term option. It's a part of our culture, it's a part of emotions, a part of festivities. So even gold prices till now have not been a jitter. There have been short pushbacks where people have adopted a wait and watch model, but have again entered the market. As I'm saying this from the Q1 result, that Gudi Padwa and Akshaya Tritiya both were at a time when prices were really high. But we saw a phenomenal increase in sale on both these festive days. Gudi Padwa, in fact, had a 70% plus jump on a single day sale compared to the last year's Gudi Padwa. Same Akshaya Tritiya, 35-40% jump in sales. So this gives me confidence to say that I think the Indian market is strong and people are looking at jewelry with a long-term perspective. And I think gold prices would not be much of a jitter. There can be phases when people may choose to wait, may choose to think a little before making the purchase. But I think the market's strong, and I don't see a big impact on gold prices really having on the market. The season looks strong ahead, not only the Shera Diwali, but also the upcoming wedding season. So all in all, I think the sentiments look positive, and gold, even though it's in a high, the sentiments remain bullish. Consumer interest remains strong. So I think from the perspective of the season, the market looks good, and I think the demand looks good.
Right. Sort of looking ahead, right, because the price of gold has gone up, your value of sales has also jumped significantly. How much of the recent revenue gain or the increase in revenue you're working with over the next couple of quarters can be attributed to volume growth? So what is the sort of volume growth you're expecting in the next few quarters?
So when it comes to volume growth, in the Q1, we have seen 15% plus volume growth. Value has been 35% and volume has been 15-20%. I think to sustain ahead, 10 to 12% volume growth is something which we feel we should be able to achieve. Like you rightly said, value can be much higher, but what we track closely is also volume growth, and that I think should be 10-12% at the company level.
Right. Saurabh, I want to understand any inventory gains. What is your hedging policy, and what, have you held any inventory at low prices in the recent few months? Give me a sense of that. Any sort of inventory gains that we can expect going ahead once we get a sense of your hedging policy on gold?
We are using gold metal loans and MCX as a part of the hedging strategy. So post IPO, most of our stock is now backed by gold metal loans, and the balance would be covered by on MCX. So when it comes to pricing, we would be fully insured and would not be seeing any gains going ahead. So the policy now has been like we would not be open to looking at the gold price risk on the stock book. Q1, yes, we were not a listed company, so there was a impact of a bit of gold gain, and the impact would be less of 5 crores on the PAT level.
Right. Saurabh, just a quick one on margins. Margins have seen a marginal improvement in this quarter. Looking ahead, what is the outlook on margins? And also what I want to quickly understand from you when I was trying to understand on this hedging policy is that can we expect you to have made money on increased gold prices, or you buy and then you sell? So there's very little that you can gain in terms of pricing or the gains on gold prices.
We have made very little on the gold prices because we buy and sell, and since we do on an average more than 5 stock turns at a company level, the impact is not very high. But having said that, like I mentioned, the impact would be 4 to 5 crore on the PAT for Q1. As post listing, we have adopted the policy of gold metal loans and MCX, so that would neutralize any impact on gold price movement.
Right. Saurabh, what is the outlook on margins? Can we expect that to improve going ahead for the rest of the financial year? Any upside risk to margins?
The margins the margins currently what we're looking at, I think are definitely going to be sustainable. We should see some positive improvement on those lines. At the retail level, we have seen that, the store level, we should be looking at a 13-14% gross margins. And we are looking at the EBITDA levels of around 7% at retail and around 4% PAT levels. And that's something which we feel is what we are aiming for. Diamond portion is increasing, so that's going to be an added buffer to the margins. But having said that, these margins, what we have today have seen, I think are definitely sustainable.
So what store count are you targeting at by the end of this financial year? And I know with the recent listing, you've managed to have quite a healthy sort of cash balance on your books. Would you also fund these new store additions through accruals?
We have already mentioned publicly that we are doing 9 stores in the 9 days of Navratri. So today is the fifth store launch, and we have 4 more store launch. So as of end of by Diwali season, we should be adding 9 stores to the tally. And post that also, there are some plans for the expansion. And as we have mentioned in DRHP, the plan is to add 12 more stores, primarily in the state of Maharashtra, and that is what we are on track with.
Thanks for tuning into Talking Point today. I'm your host, Neeraj Shah. The case for a chat, and right up on your screens here, are FI outflows a fleeting concern or not really so? Can Q2 results aid valuations by proving to be a good quarter, or will it on expected lines be a bit of a dampener? Are new age companies the best way to play consumption if you want to play consumption in the first place? And that's a micro point, but the macro point is the legitimate pieces of concerns that we probably have around markets currently. Are they indeed that legitimate? The best person to answer all of that in his own style, Mr. Samina of Ugro Capital. Samir, so good having you. Thanks for taking the time out.
Good morning.
Samir, just trying to understand, is this a legitimate concern that the markets have had in the recent past, this whole allocation to China? Because we're seeing inflows into China, outflows out of markets like India. Is this a fleeting thing, or can this last?
I think this is a fleeting thing. The many things can be there on valuation and others which may take longer. If some people believe that, we can discuss that also. But on China, my point generally is that many people were extremely underweight, and many people were, on the other hand, extremely frustrated. And these were the large investors who had, in interviews or in the newspapers, foreign newspapers, you could read them talking openly about what their views were on China, that, and these pension funds and endowments and others who I don't think can change on a dime. So therefore, I think that the large guys will not easily be moving from one market to the other, because just understand the structure of the emerging markets benchmark or the index. So there are maybe less than 47% combined India plus China. And there is 52, 53% in markets like Taiwan, Korea, etc. So if somebody wants to now invest in China with a fixed amount of money, there are many other places from which logically you can move to China if you so want. Because these are two different trades. One is supposedly a secular long-term trade where most of the things are working all right. And the other is more it went to extreme value and is already up 30%. So by switching from here to there, what extra value add will you do in a short period of time? But in a short period of time, some hedge funds, some people who were caught on extreme underweight or short in China may be doing it. So I think it's a fleeting trade. It doesn't change the long-term attraction, maybe of both. But I don't think one is at the cost of the other. In fact, India is in absolute terms, maybe not in relative terms, better off if China and all do somewhat well. Because one criticism of India was that our Indian market valuation premiums to emerging markets have gone up a lot, to Asia, ex-Japan valuations. And a large part of that was triggered by the fact that China was doing very badly. And second thing is, if all other markets are doing well, that is US is clearly doing well and China also is doing well, then there is less reluctance on the part of the Indian mutual fund managers sitting on cash. Because if the world is up, we are unlikely to be down. We may be less up.
Okay, yeah, that's a telling point too. Just wondering, Samir, though, I mean, the part two of the question was this, that at the end of June quarter, FI ownership in India was what, 17% 12-year lows, what have you. There were some right, somewhere around that. And then there were some inflows, never mind the outflows that have happened last week. It's not that FIs are really overweight India as well, right? So therefore...
Absolutely. If you look at the MSCI index, I think they might be plus minus, they may be plus 1 or 1%. That is, India's weight at the end of August, I think, had become 20 point something or 21, which was supposedly just crossing China at that time. And then with the sharp rally in China, their index weight must have gone back to whatever, some 24, 23, 4%. But even prior to that, it was not that India people were so overweight that trade will be played, which is sell India to buy China. And that also after a 30% difference between the two markets in, say, a month.
Got it. So therefore, the 45 odd thousand crores of outflows that we've seen, let's say, right, in the last week odd, if you will, skeptics would say this doesn't change easily. I heard you say that this might be a fleeting concern. You reckon the pace of outflows over the next 2-3 weeks will moderate?
It will moderate, but first of all, the timing of that the pullout was also at sort of the same day, on the day when SEBI was supposed to come out with the rules on F&O, and this happened prior to that. I think that day, when in the evening the thing was, that day also they took out a big amount. So who knows what was the exact reason for taking out. But I can't big picture imagine that this pace can continue. And I think the pace, by the way, wasn't Friday lower than Thursday anyway, by 2,000-3,000 crores. So I think it will decline with time.
Got it. Geopolitics has only increased, Samir. I would love to know. For the longest time, we said Russia, Ukraine, now it's going, the world has learned to live with it. Then something else, now a heightened Israel-Iran issue as well. Is that a concern in your mind for markets?
So it may be a concern, but why should it be a concern only for Indians or Indian market? So I'm only driven by the fact that gold is not up a lot, that oil is actually not up a lot. I mean, it was down so much that if it goes up 6-8% is part of life. And the stock markets are not down anywhere. So, I mean, they are not down, or maybe they are up actually. In US, it's up month to date. And of course, China is up. So why are we taking it as if it is our sort of duty to reflect that? Although big picture, you can say it's a concern if things go out of control. But why only for the Indian market? So one reason could be that India had generally done well. But as of now, year to date, India has not done anything great, at least at the index level. Or if I look at the Nifty, it is up 15% in rupee terms, and the year is like 2-3 months, so you can annualize it and make it 18%. And generally, our longer term returns of index would have been, say, 14%, 14.5%, 15%. So it's up 3% more than what it should be. What's the big deal in that? Even if you look at 3-year numbers, even if you look at 5-6-year numbers, the real story is that the small caps and a part of the mid caps have done very well. And it's that which is responsible for us all feeling that the market is rocking beyond limits. Just to give you some perspective, in the calendar years 2004, 5, 6, and 7, for 4 consecutive years, the annualized returns of the NSE index or NSE 500 index or whatever was some 45% per annum for 4 years. That is called a bull run. Here, a small part of small and mid-cap stocks going up is a good bull run, but it is not, I don't think it is some wild thing that is happening.
Okay. So, is Samir Arora constructive on Indian equities from where we are right now?
Yes. We are constructive because my thing is, number one is that it is very difficult to preempt these global issues. So if somebody says, oh, what happens if tomorrow Iran comes in or these Israel guys go and again attack Iran or something happens, then we have to react. But preempting these global issues, for example, China is very aggressive in Taiwan, let's say, not today, but I think in general. What am I supposed to do about it? Because they may be only talking, saber rattling, never do anything, these things. For example, if on 21st February, or whatever the date was of 2022, you had said that Russia will be fighting with Ukraine, you would have, no, these things don't happen normally. There is this, there is NATO, there is UN, there is, you blacklist these guys, you sanction them, nothing happens. So these things are very difficult to say. And even there, when I actually got negative and raised 20% cash for 2 reasons in 2022. First reason was my correct view that the interest rates will be hiked a lot. For whatever reason, I can remind you, I said it even in Jan-Feb of that time, and they were raised a lot. And then the war happened, and we raised 20% cash, and the market did not fall, I think, even 1% after that. Maybe it went up 3-5% for the rest of the year. So this raising of cash is a very difficult thing, which is the end result of whatever this analysis we are doing. And today I feel that if US market is very good and the Chinese market is very good, we may underperform for some time, do this, that, but we are not really falling to make my normal stance and my normal actions very, negative.
Okay. One of the things that came out in conversations, I was out for a few days, and people cited that the state election exit polls are also turning out to be a bit of a concern. To your mind as well, is that a concern? I mean, we don't know what the actual result will be, but...
Yeah. But assume that BJP is losing Haryana I think maybe that one was known. It might be a little bit more if they lose Maharashtra. But generally, after the elections, the day-to-day thought or thinking that what the government is doing and what policies they are doing and what changes they are bringing has come down. Now, that is good or bad. It could be considered good in the sense that the market is no longer depending only on government announcements and steps, because many of them were announcements and they take so long to convert to reality on the ground and earnings for corporates. But that is true actually since the budget, and that's why there's been a change of somewhat leadership where the PSUs and defense and railway guys are not doing that well as they were. And that I've been saying since the budget day that that has changed, yes.
Okay. So Samir, I'm just trying to understand, because you got this great global experience, right? If you were this large fund, and I heard you say that those large endowment funds don't change in a hurry, but China valuations attractive, they are giving stimulus, so on and so forth. India, expensive valuations on a relative basis, and geopolitics, etc. So if you had a choice of allocating fresh money or reallocating, would you actually do large changes if you had the choice to?
So that's what I'm saying. Even, by the way, we have a global fund.
Exactly, which is why I asked
in January, we had bought 2 stocks after 1 or 2 years of China, Alibaba and C-Trip. And then last week also we bought Alibaba. Okay, I'm not the main fund manager there, but I'm sort of part of the gang. So the thing is that the reality is that it is cheap.
Yes.
And if it is turning, it can go up. But let's talk now from a point of a fund manager who is invested in India. And he's, unlike this global fund where we bought how much, that total 4-5% combined. But if you're looking at a fund, emerging market fund, or other guys or people who have given money to separate accounts and things like that, and there is, in theory, India plus China plus 53% in other emerging markets, plus you've done well in Japan. So all that money, and plus most of these funds keep getting some new money, plus the trade difference between India and China is already in 1 month some 30-35%. So how many people, how much money do you think will go on that basis, where separately India as a secular story is well accepted, was well accepted. See, it's also an issue of embarrassment. If you got to the board and said that we are stuck in China because of being stuck in private equity, as they've said in many interviews, they said to us face to face in many meetings we had in January, February of this year, saying that there is no payout by the PE funds and therefore we are not able to invest in India, and that China, we are down so much. And suddenly for them to go back, the people who are of that kind, where they go to boards, where they have investment committees, where they have political issues of investing here or there, whereas there is a separate crowd of hedge fund guys and small funds who may be underweight in China, and even with a 30% move, just like Indian or even global fund managers come to India and buy these IPOs post-listing when they are up 40-50%. And you can see in these 2 recent IPOs where people bought them after a heavy pop on day one and the stocks are down 20-25%. Broadly, some of them will have the same experience there. But even if not, and even if this continues, this is a shorter term trend, plus minus 15, 20, 30 days, I think less than that. This part, that if any money is actively being taken out of India to put into China, that trade is not longer than this, I think. But normally they will do well, and people may allocate more new money to it and they may outperform India for some time. That is possible. It's like value stocks outperform growth stocks for some time, 1 or 2 years, and then that's possible. But I'm saying it's unlikely that we'll be negative.
Got it.
If every other market is positive, and that is the first point.
No, I find it interesting that the narrative in the last 7-8 days has moved so much to the FI outflows, wherein the narrative for the previous few 9 months was mutual funds are sitting on 1.5 lakh crores of cash. So, dips will be bought into. So you reckon this is a dip that is waiting to be bought into?
Well, it is being bought in the sense that if you see every day the mutual fund and FI flows match each other, because that is also reality.
That's
if they're selling, who is buying? Somebody has to
True.
I think the other thing is that, let's say that Indian market was some 20, people used to say it's 15 odd % overvalued compared to its longer term history. That means P of India and P of, say, emerging markets or Asia, but mostly emerging markets, say 15, 18, 20%. Now, with the Chinese market having gone up, say 30%, and its weight in the index about 20 odd %, that means it has itself pulled up the whole valuation by 5-6%. Therefore, you are now, say, 10-12% overvalued, or not overvalued, higher than what the longer term average is.
Right.
It doesn't have to be that you have to get to longer term average, but it is within ballpark. You're not going to be paranoid if you are saying that we are 10-12% higher than our longer term average, because then on the other side, we will give you 15 reasons why India is doing well. It's become a large market. There was still a China +1 trade. Our fiscal deficit situation is better than many countries. Our current account deficit is sort of 1% type, so our currency may depreciate less, blah, blah, blah. We are the 4th largest market. So when we go up a little bit also, the world cannot ignore us.
Right.
You could have said, okay, we are the great market, but you are like a small cap stock, which it doesn't bother me. So you can say 5% is because of these reasons, or domestic flows, which has reduced volatility of the market. And you reduce volatility of the market, that itself, which in theory should reduce your cost of capital and increase valuation, blah, blah, blah. So therefore, big picture, plus minus a few % here or there, you are like you were before, which means reasonably valued for reasonable returns.
Reasonably valued for reasonable returns. Perfect. So, Samina, if you were putting in money to work, would you, by nature of the first answer that you gave me, be inclined to put it more in the larger pockets versus the mid-size, small-size ones?
In general, yes.
In general.
But what happens is the analysts in our firm and in every firm come up with these ideas saying my mid-cap is very good because it is doing this. So since being bottom up, the large caps you buy only saying, okay, they haven't gone up. But there is no real bottom-up excitement in them. And therefore, it has to be a combination. And even when we keep saying that large caps will outperform, in the end, we do at the same time talking and buying mid and even small, because that is more bottom-up fun. But yeah, in a big picture sense, it is large cap. Actually, by the way, although it was not intended to be that, but Helios is just launching a large and mid-cap mutual fund in India in a few days.
Okay. So but you're saying it's not intended for that, but the theory would have been.
I'm saying I didn't plan it with you, and you didn't even know in case that this was leading up to this great question.
Okay.
I am not into all that.
Yeah.
We can do it without all these things. But I'm saying in general, yes, even we felt as a firm that large. And what I'm saying is, but in a flexi cap fund or in my offshore fund, it's not that I've absolutely stopped buying a mid and small, because in a big picture sense, I feel that mid and small have done very well, because you feel more excitement and more discovery kind of thing in something smaller in that sense. So it's both.
Okay. Samir, you mentioned that 45% CAGR performance for the NSE 500 2004 to 2007, and saying that that's the real bull market.
That's a bull market.
So am I to assume that you believe that this is still an ongoing version of a bull market, if you will?
Let's do numbers only. So just to give you what is a bull market. So right now, if you look at the last 5-year returns of the NSE 50, Nifty.
Yeah.
So Nifty, I think, will be some 17-18% per annum. Okay? Depends on which day you start and you drop off some day there. And the market, if you do longer term, will be some 14-15. Depending again on which period you consider long term. So you are some 3% more per annum for 5 years. So that's a cumulative outperformance, let's say, of 18, 20%, 17%, 15%, right? And now that 15%, if you're overvalued as compared to a longer term average, how many things will you change for that? Because it is not wild beyond limits. Just to give you a perspective of what is a bull market and what is a mad bull market, in the year 1999, the NAV of my fund which was the Alliance Equity Fund, in the calendar year 1999 went up 280%. And our balance fund, which is now both these are Birla funds, the balance fund, which was Alliance 95, now called Birla Sun Life 95, the NAV was up 170% for a mutual fund. That is what I call a bull run. And then in 4 to 7, the annualized return of the market was 45% per annum.
Right.
And my hedge fund went up plus minus that, which is only 60 net.
Sure.
So that is a bull run. Here, the bull run is limited to a few stocks. And those stocks, if you don't buy or you buy less of. So recently, Kotak put out a report, and Kotak is negative, as you know, on caps and all. G. Prasad must have been the author, I think. That they looked at the mid-cap 150 stocks. But they did only for 1 year, I think. And they say that 25 of the 150 stocks were responsible for more than 50% of the index moves. And some 30-odd stocks were below 10%.
Right.
So it is. Large caps haven't done great because we know the banks haven't done great, the IT hasn't done great, the traditional consumer hasn't done great.
Right.
But some other things have done well, like these oil and gas and PSUs and others. So therefore, maybe that index is okay. And then in the mid-cap index has done well. But again, there it's a bit concentrated according to at least for the last 1 year or whatever. So don't buy some of those. So our conclusion is, don't do the obvious bad things. Rest you can continue to do. And according to me, one obvious bad thing is not that don't buy IPOs, but don't buy an IPO after listing. That is height of ridiculousness, particularly when they are popping 30, 40, 50% on broadly very expensive IPO price to buy that. That is overdoing the madness.
Okay. So what is obvious non-silly things? I'm just trying to understand. So you gave us the avoid list. So maybe it's a defense, the
obvious non-silly things are financials.
But that's large cap.
Yeah, that's large cap. But you know, in financials at least, the rest of the financials, not only the banks, even others, at least they grow properly. They grow 15, 60%. Here we are buying that there is rain, so this fellow, instead of growing 3%, will grow 7% or something. That I don't like that, but that somebody may do or not do. But I saw your initial listing that what is the best way to buy a consumer? Is it to buy the new age? Well, some of it we agree, since we have now all the three new age companies, which is Paytm and Zomato and PB Fintech. Yeah.
And you think that growth story, never mind the valuations, is still intact and alive and kicking and will deliver returns?
That's what we think, that the growth is very good and here is a shortage of high growth and there is no real big competition. In the case of Paytm, which we own, let me again explain. The thing is that a second company cannot go public unless this guy does well. You know, all these other 25 fintechs can go dream of getting listed. This stock doesn't do well. And in a big picture sense, what happens is it's not that they start buying the stock to make it go well, but they change themselves and they try to make some money so that they can go public by saying we are not loss making or we are making very less loss. And therefore that helps the listed company. And you can see that literally happening. And me indirectly telegraphing it via Twitter in about 6-9 months ago that Swiggy cannot go public unless Zomato does well. And so what happened was Swiggy then introduced, or maybe they followed, but the platform fee came in and then Zomato did well. And when Zomato stock went up, Swiggy can say, hello, I'm coming at a discount to you. So these things happen in every sector where if the first guy has not done well, the second guy cannot go public, and if the second guy has no money and the first guy is public and has money, then sometime later the second, third, fourth guy have to start competing less and worry about their own profitability. And as soon as they worry about their profitability, the first guy also does well. This is my big picture thesis. But otherwise also the growth rate in these things is better than our 5-7% growth that these staple guys do because rain is coming. I remember in the 90s, our office was in Worli and we would look out and the joke used to be that if you see rain, That's where the fund managers are sitting. Then you go and buy Hindustan Levers. Those days, I think, are not. I don't want to do those.
Okay. Since we're talking IPOs, Samir, going public, etc., the talk of town will be the mega Hyundai IPO as well. I'm not asking for your view there, but it's the first auto IPO after a long time and no scarcity premium. And a lot of people compare Hyundai valuations in Korea to Hyundai India's valuations. Maybe partly faulty argument because everything in Korea is cheap. I'm just trying to understand, what do you think about autos per se, and therefore maybe an IPO in this space?
I have said it in a big picture sense. The number one most ridiculous trade in the world, not just in India, is auto. It is absolutely top down, so easy to prove that it is a wrong trade. How? So there are these auto companies, which I've said many times, so I feel like repeating myself. But you have these IC engine car manufacturers, and the system or the society or whatever, consumers or climate, this thing say, now you have to make EV cars instead if you want to basically be remaining in business. So all these guys spend billions of dollars to move to new technology, but there is no promise that therefore the market size will go up or that your profitability will go up. You are basically spending all this money to remain in business. That itself would have been a very big capital destroying activity. But in addition, what happened is that there were new competitors who had no plans of being in IC business, and suddenly when the EV business started, they said, oh, this we also can do for whatever reason that they thought they had. And so from Tesla to BYD to Ola, all these guys who were not there in the original industry structure are new players. Again, has anybody ever said to you that because we are all moving to EV, that the market size is going up from what it was, say, before this happened? Or that the profits will be higher? No. For the same industry, the number of players are more, and you are all having to invest. Now, the only thing we can say in India is, oh, we are protected. You tell me how much multiple will you give to a company which is making its money because of protection. And you know that every guy, not just the Korean guy, every guy in the world has warned about declining sales. Their stocks are down 20-30% this year, whose multiples are 4 to 5. But no, we are here. So in some things we also accept, but this is too blatant according to me on every angle.
Samina, thank you so much. Trust you to call a spade always, but thanks for taking the time out. And festive greetings in advance, Samir. Hopefully we'll talk once around the Diwali season.
Okay, thank you very much.
Bye. And viewers, thanks for tuning in to this leg of Talking Point.
Markets fall again from the day's high as Nifty trades at 25,000. Sensex trades above 81,900. The broader markets the benchmark outperforms the broader markets. Most sectors trade lower, dragged by metals, media and PSU banks. Meanwhile, IT, private banks and FMCG see marginal gains. NSE has received a major boost in its bid to list on bourses as SEBI on Friday said that the NSE has settled a case involving alleged violations in trading access point by paying a settlement amount of 643 crores. Exit polls predict Congress set to come back in power in Haryana while Jammu and Kashmir Assembly staring at a hung house. Welcome, you're watching the FNO show and it's a tough Monday morning. We were hoping for some significant respite after coming out of one of the worst weeks since 2022 for the Nifty. The Nifty has been down 4.5%, but we did see marginal gains in early hours of trade, but the markets have given up most of it, with the Nifty now threatening 25,000 on the downside. The breadth of the markets deteriorated as well. Last week it was the broader markets that outperformed the benchmark and witnessed a lesser or a smaller cut than the benchmark. But this week has started off with the broader markets actually underperforming the Nifty itself. The broader markets are down 1.5%. The Nifty 50 is sub 25,000 as we see it. Well, it's not looking great, Agam. We did expect it to be some respite, at least after that big sell-off last week. Saw a gap up about 25,100, but it's gotten sold into. So I think any opportunity is being used by traders to sell or cut long positions.
Yeah, well, and it is evident, very evident in fact, because if you actually notice the way broader markets have behaved over the previous few days, what we've actually seen is that the correction in the broader markets is a lot deeper as compared to your benchmarks. This also means that because of the substantial run-up that we have seen over the past few days, or rather past few months, in fact this last 12 months is actually being sold into now, with a lot of your traders and investors taking profits off the table. And what we're also seeing is foreign institutions specifically, well, moving out as much as nearly 42,000 crores over the course of the last 5 days. It's a relatively large chunk. It's nearly $4.5 billion. And that's perhaps something to be concerned about at the moment. Now, while the benchmark is holding on to 25,000 right now, we have actually seen very, very sharp cuts in the broader markets. And it is very evident that we are seeing about a profit taking. The question really is that at what point in time does this correction stop? And at what point in time do we start seeing a little bit of consolidation, a little bit of sideways movement coming in, especially given the fact that the Nifty has come off from levels of well near 26,300 all the way to 25,000 now. In fact, we had gone below that mark last Friday as well. That's something that we will watch out for. But for now, how are things shaping up? Are we looking at further weakness? Are we looking at more shorts into the system at the moment, considering the benchmarks are already off days highs this Monday morning as well? Let's pull up the futures. Let's pull up the October series and how things are panning out. And that should be up for you on your screen in just a few moments. There you have it. Actually, nothing happening there. And what about your Bank Nifty futures? Well, the picture may not be very different. We're once again looking at, well, about a 1% increase in traction, but it's not too much to read for. And do remember, there's been a substantial increase in open interest over last Thursday and Friday. And what we're also seeing is, even as the Bank Nifty comes off by quite a bit from once again making a life highs last week. So it does seem like the markets are hitting a little bit of a break right now. And over the next 2 to 3 days, we will get to know at what point in time can we start seeing sideways movement, or are we expecting to see further correction, where the probability is a little lower considering we've already seen quite a bit going on over the past 2-3 days. But again, it's a wait and watch, and no one can really tell in terms of markets when they're uncertain, especially when the VIX is high. But this is how things are panning out, Samina. 25,000 is where the Nifty is taking support. And if we do see that break, 25,800 and thereabout will be the last line of defense. After that, it's going to be a lot more weakness.
24,750, I believe, is an important sort of technical as well that the street will be tracking. Remember, we go into earnings season on Thursday. Wednesday, you've got your MPC meet. All this while the global setup still looks very confusing as we see it. The VIX had opened the day with a small decline, but now, as you can tell, it's again jumping up well above levels of 14, which is fairly discomforting if you're a bull on the street. Richard Jain and Amit Bhuptani both join in with their trading calls this morning. Richard, I don't know whether I can even call it a trading call, but let's start with your view on the Nifty. It's failing to sustain at higher levels. I know the advice going out is for traders to remain cautious and use every rally to exit or cut your long positions. What do you believe? Do you feel like this is an intermediate break and maybe by the end of the day, we should resume the upward journey?
Morning to all of you. Well, if you look at the data, then the data had indicated earlier only that we would see a corrective phase because the October series started with FI's long-short ratio at around 81%. And historically, we have seen that whenever FI's long-short ratio, long positions in the index future reaches about that 80 to 85% range, and the market makes a short-term top and we see a corrective phase because of unwinding of these long positions. So I think that's what we have seen in last 1 week. That ratio from 81% has now declined to 58%, where there's a combination of short formation and unwinding of long positions. But 58% is also not that short heavy. Still, they have long position, net long positions, which could we could see some unwinding in the near term. So I think for the near term, markets would remain under pressure. Technically, the lower time frame has a bit oversold setup. So somewhere around 24,800 to 850, where the retracement supports are, we believe that there would be a pullback move again from those levels. So I think 24,850 to 800 for short-term traders, that could be a range where one can initiate buyings, but only for a pullback move, unless we see FI selling getting absorbed or that getting stopped. So I think near-term market direction would remain cautious only.
Right. Amit, what about you? How do you feel about the markets right now? Are you avoiding actively trading the index, or do you have a view, a long or a short one?
Yeah, good morning. So if you look at the overall market scenario from last 1 week of data, it's completely visible that it's not a good slip for the FNO traders because continuously, if you look at the event lineup for the overall October series, tomorrow we will be seeing the assembly election result for the Jammu and Kashmir and Haryana one will be a big setback for the BJP government, due to which we will see the pressure will be intact for the market on that note also, and also the Iran, Israel and the US election data. So overall for the month of October, we will see some kind of a pressure to be witnessed in the market. On the Nifty front, if we look at the overall data, Nifty has broken down the 61.80%, which is the golden ratio of the Fibonacci for the Nifty. And below that, if Nifty in today's session gives closing below 24,980 level, then we will expect more 500 to 800 points selling on the Nifty front towards the 24,300 to 24,000 marker. So till the time Nifty is not going above 25,200 level on the closing basis, till that point of time, we will not expect any stability in the market and we will see more selling to be witnessed in coming days of trading sessions.
All right, so that's the view as far as the Nifty is concerned. But Amit, coming back to you on your assessment of the Bank Nifty, do you expect it to move in tandem?
Definitely, if you look at the Bank Nifty is currently trading as a 50 DMS support and it is about to break that support level. On the Friday session also, we have seen that the 51,700 has been witnessed as a supportive zone. But once if Bank Nifty gets broken below 51,700 level, then we will see pressure from the Bank Nifty also coming towards 51,000 marker. So once if Bank Nifty goes below 51,700 level, at that point of time, we expect the shorter session to be created from the Bank Nifty front also.
Right. Richard, you want to share your view on Bank Nifty with us if you have one this morning?
So I think the Bank Nifty and the financial stocks have witnessed sharp short formations in last few trading sessions, and that shorts are still intact. Now the immediate support for Bank Nifty is coming around 51,200. So things are a bit oversold post this last 1 week sell-off. So I think these are not the levels where I would advise creating fresh short formations. But in case if one has to take some risk, then around 51,200, one can initiate fresh longs with a stop loss below 50,900 and expect a pullback move towards 51,800 to 51,700 zone.
Well, so that's the view coming in on the Bank Nifty. But let's talk about stocks then, and let's talk about those stocks which are actually seeing an increase in open interest. And we have for the shorts. Now, remember, names like Dr. Lal Path Labs were actually showing some strength, on Friday, and that's been well sold into. Tata Chemicals was on one other counter, which was actually showing some amount of strength earlier on the session, and then it actually showed a lot more weakness. The stock turned around, and now it's looking at another knock of around 4.5–5% right now. Moving on, we also have L&D Tech. That's the other one to keep an eye on. But among stocks which are seeing unwinding, Metropolis again under pressure, and the quarterly update has not been terrible. Fair enough growth that we've seen, double-digit growth, about 13% coming through. And Ramco Cement is the other one, which is also declining by around 2% for now. But in general, we're actually looking at perhaps the overall effect of the markets, which is weighing down on a handful of these stocks from the futures and options space as well. But what are the stocks that are coming on the radar of our experts? Richard, coming to you, stocks that are looking good to you.
So I have two recommendations. First, on the short side, Syngene is looking a bit weak. In the recent correction, the 40 DMA acted as a support, but that has been breached in today's trading session. So I think one can expect some further pullback moves in Syngene. One can go short in the futures segment with stop loss above 879 for potential targets of 840. And today, some contra trade can be taken in some of the large or mid and large IT names. Because the Nifty IT index has been taking support around its, have been consolidating, and it's taking support around its 40-day EMA. So LTI Mindtree within this space, I believe that the price-wise downside seems to be very limited. So the risk-reward ratio is favorable over here. One should check. One can look for buying positions over here with stop below 6,100 for potential up move towards 6,500.
Right. Well, that's, of course, the view coming in and trading ideas from Ruchit. Amit, what about you? What are your recommendations for our viewers this morning?
Two recommendations will be there, and on the hedging front, one will be buy and one will be short. On the buying front, Coforge will be the buy recommendation. As per the current scenario, we are seeing that the pattern which has been created from the Coforge on the quarterly chart, or we are seeing that the cup and handle pattern has been created from last 2 weeks of trading session. We are seeing that the consolidation is taking place and the volume is strong, frontly getting added on in this counter. So we expect in the Coforge, the buying momentum will be seen again once the counter goes above 70–100 level. Then long need to be created for the target of 7,300 to 7,350 on the downside, with the support of 7,130 level is the support for the counter of the Coforge. The second counter will be Deepak Nitrite. On Deepak Nitrite, we will create a new short position. The breakdown has been quietly visible in the counter. The put positions are completely getting shifted on the downside, and the call writer positions, we are seeing that 2,800 to 2,800 strike. We are seeing the call writer positions are getting added on. So we expect a selling will be witnessed in the Deepak Nitrite. We have recommended this counter to our clients also. On the downside, we are seeing that the target for the counter, which will come directly towards the 2780, will be the first target. But we are seeing from last 15 minutes, the selling has been witnessed. So we will modify our target towards the 2760 to 2740 levels on the downside, with the stop loss on the upside towards the 2900 will be the stop loss for the counter.
Well,
all right, well, there you have it. So that's as far as, a couple of calls from Amit go. But let's also start taking a look at queries then. And the first up, we have Deepak from Maharashtra. And he says that he has the RBL Bank 200 call. He's paid a premium of 10. The question is, what can be done with this one? Now, let's pull up RBL Bank. Let's see where it is with respect to that particular strike. That particular strike is currently 200. Its RBL Bank is at 194 right now. And what you're seeing is that that particular premium is currently trending at around 7.5. So the premium paid for it was around 10. The question really is, what can we do with this particular move coming in? Well, let's take this up with Ruchit. Ruchit, your view on RBL Bank, and also what would you do with a 200 call?
So if I am looking at the options data today, then there was a significant put writing at 200 strike price, where unwinding has been seen today, and stock has also breached that level. So I think 200 was the support which has been breached, and since the put writers are unwinding, that could lead to some more pressure in the near term. So my call will be to take an exit from these options until we see a closing about 200 again. I think the recovery looks unlikely, at least in the near term.
Right. We have another query coming in from our viewer. And this one, of course, again, is one from Arfat from Calcutta. Now, Arfat is holding Titan calls 3,700 at a premium of 40. His question is, what should he do? Amit, not sure why Titan is looking so weak this morning, despite the fact that its business update came in better than what the street was expected. But that's, of course, fundamental news flow. On the charts and technically, how do you view Titan at these levels, and what should Arfat do?
Counter currently has taken the support of 200 DMA on the downside towards the 35.25 level. Once again, if the counter gets broken below 35.25 level, then 100 to 150 points of breakdown will be visible on this chart. So we will hold the counter with the support on the downside towards the 35.25 level. The option currently premium is going around 50 level, so you should place the stop loss on the downside towards the 36. Once if this option goes below 36 level, then the position need to be exited. So place the stop loss at 36 level. Once if this option goes above 58, then we will again see some stability in the counter.
Okay, that's the view on coming in on Titan. And when we move on to the next query that is on our radar, and this one is on Aditya Birla Fashion and Retail. That's ABFRL, which is also in the F&O. And I'll take this one up with Amit again. So this one is from Urja Panda and from Rajasthan, and the question is that Urja has a 350 call and paid a premium of around 9. Should I hold or exit? Let's pull up this specific call option. Paid a premium of around 9. It's currently trading at 3.35. The specific call taken is the 350 strike, but it is currently trending. The spot is trending at 323. Amit, come in on ABFRL and the October 350 call. What would you do with this?
Counter has given a 50 DMA breakout. With that, we are seeing that the put buy positions is continuously getting added on. If you look at between the 320 to 300 strike, the IVs of the put buyers is continuously getting added on, due to which we expect the buying trend will be stopped in this counter, and we will see more pressure to be witnessed. On the rollover front also, we have seen that good buying has been seen from the rollover front also, and the position has been shifted on the positive side. But from last 2 days of trading session, as per the market scenario also, all the buying momentum has been gulped out in this counter. So we expect more selling will be continued in this counter towards the 310 to 305 level. So long position need to be exited in this counter, and short position can be created at this point of time.
Right. Mahindra now writes in from Madhya Pradesh, and is holding Polycab 7,600 calls at 160. Ruchit, how do you feel about Polycab? What do you recommend Mahindra should do?
7,600 seems a bit fast strike price. If I am looking at some historical data, then in mid-June, somewhere in the end of June, the stock had resisted around that 7,300, 7,350 zone. And even last 2 trading sessions on Thursday and Friday, the high is similar to around that 7,350, 7,400 range. So the previous highs were there where again resistance is seen. So I think we could see some pullback move again towards 6,800 kind of level. Although the mid to long term trend is positive to hold on for cash segment, but not for the option segment. So I would recommend him to exit from that 7,600 call option. That does not seem the stock would rally towards that immediately.
Amit, just very lastly, how are you trading banks? I mean, do you feel like HDFC, ICICI Bank may see some opportunity to make a quick in and out buck, hoping that after that big fall last week, there could be some low level trading opportunity?
I'm not expecting any bounce back currently in the market, because if you look at the overall premium front also on the Nifty and the Bank Nifty front, we are seeing that the Nifty is trading in a premium of 180 points. So it is quite visible that the position which is getting exited right now is from the equity front and the call front, but the position is still not getting hedged on the future front, due to which we are seeing that much of gap has been witnessed from the COC basis. If you look at the Bank Nifty front also, as I said, the Bank Nifty is trading on the average support. So once that support gets broken out, already this counter are ready for the breakdown of HDFC Bank, ICICI Bank, all are ready for the next round of selling pressure to be seen in the market. So currently, for any pullback, I will see and I will tell that we should wait and watch for any pullback. New short position can be created, and anyone is holding the long position, I will strictly tell them to place the stop loss orders.
All right. Well, there you have it. That's as far as the queries are concerned. And on that note, going to thank both our experts for joining us and taking us through their views on the markets, giving us a couple of trading ideas, as well as, of course, solving our viewer queries. But with that, we shift focus to the commodity space, and we have Dinesh Somani of Pro IntelliTrade Services, who joins us for the show. Dinesh, good morning. Thanks for taking the time out. Once again, let's start with your view on gold. Well, it does seem like it continues to move and show a lot of strength right now. But are we looking at some breaks, or do we continue to expect that up move coming through?
Yeah, good morning. We could definitely see some consolidation happening. Prices moved up from 66,000 level to 7,600 levels. Almost a move of 10,000 rupees, and there could be a consolidation for short term. The major factors moving gold would be the Middle East tension and the cut in the interest rate that could happen in short term from the ECB and from the Fed as well. There are 70% chances that there could be a 25 basis point cut from the Fed, and there are close to 30% chances there could be a 50 basis point cut. These are the factors that could drive gold in near term to short term. Overall, I expect a fall for intraday. If we expect a fall around 75,900, 75,920, that could be a good buy level. Upside potential for a day or two should be 76,300, 76,550. Stop loss to be maintained below the Friday's low of 75,700.
Dinesh, how do you feel about crude at these levels? I mean, 10% up move in the last 1 week. It's been one of the better weeks on crude prices. This morning it's trading flat, but do you feel there's room on the upside and a long trade at these levels could be recommended?
Yeah, last week we saw a low of around 55.70 levels, and from there it moved up to 6,300 levels. A close move of, you can say, close to 800 rupees, and that all adds. That's all because of the Middle East tension, the crisis that's happening around there. Secondly, the dollar index, which was traded around the 14 months low of 100.60, had moved up to 102.60, a major move that has also fueled the prices. I think around intraday basis, 62.10, 62.50 should be a good support, a good buying level, a demand zone. Upside could be 63.30 level, 61.40 should be the stop loss. I think the momentum which took place in the last week should be continued in the next 2-3 days as well.
All right. Okay. And well, let's also take a look at how we are seeing trade develop on some of your base metals, copper and zinc. Dinesh, how are you trading them?
Yeah, sure. Copper, we saw the prices from around 800 level that moved up to 866.50 levels. Almost a 60-65 rupees move in a very short term. There could be a consolidation for a few days. I think probably around 850, 851 level should be a good buy level. Target should be 859, 866 in the short term. Stop loss to be maintained below 847. A major breakout is 867. A close about 867 would drive the prices above 900 mark as well.
Right. Well, that is the word coming in on copper. Dinesh, I'm not sure if you track the other metals, but a quick word on aluminium, if you have an opinion on that, and also silver, because silver also usually moves in tandem with gold.
Definitely. I mean, aluminium and zinc, these are the two strongest counter among the base metals. If I say zinc has moved from 250 levels to 290 levels, and a move around 286 should be a good buying level as far as zinc is concerned. 290 to 94 should be the upside potential, whereas aluminium 240 is a good buy level, 244, 247 should be the upside potential. Stop loss to be maintained below 238 levels. If I see silver, there was a good momentum in the last session, closed on Friday, and the jobless data that the non-farm data that came in, it was very good than expectations. Still, silver prices recovered. I think around 92,500 should be a good buy level. Upside 94,500, 96,400 should be the potential target by the end of the week. 91,400 should be the stop loss.
Okay, well, there you have it. That's the view coming in on a handful of these commodities. Dinesh, thanking you for joining us and taking us through, well, your views on those very well-traded commodities that are also on our radar. But we are taking stock of the Nifty 50. It has come off quite a bit. Let's take a look at the intraday chart, because now we're inching towards 24,900. Look at that sharp cut in the last, 5 to 6 minutes. It's just sliding downwards, isn't it? And we are now down by as much as 0.5% 24,900 is what we are watching out for. Do remember that we've been keeping an eye on 24,800. The reason why that becomes a critical factor, a critical level at this point in time, is because all the premiums that have been sold earlier on over the past few weeks and perhaps even a month away, that's when those specific sold options also start getting tested. And once you start seeing unwinding in them, well, it just becomes a little bit more of a challenging market for the bulls at the moment. And I'm sure that at the moment right now, a lot of those traders are also perhaps also loosening and, getting rid of some of their positions. So that's something that is going to continue to weigh on the markets and also lead to perhaps increased volatility. But on that note, it's a wrap on this edition of the F&O show. But lots more lined up on the other side. Keep watching NDTV Profit.
Hello and welcome. You're watching the Smid Show here on NDTV Profit. I'm Harsh Saita and we'll have two interesting managements on this show. But before that, let's quickly check on where markets are at because there's some bit of pain. 0.5% lower on the Nifty 50 benchmark. You have stocks like ICICI Bank, ITC supporting the index for sure today. But you're seeing some of the heavyweights and HDFC Bank, Reliance really dragged the index lower. Reliance down just 0.5%. But clearly a drag on the index nonetheless. HDFC Bank, 25 odd negative points contributed to the index, and that's where a lot of the pain seems to be. Let's pull up the advanced decline because the broader markets are seeing, especially the SMID stocks, are seeing quite a bit of pain in trade today. You're seeing this, at least the mid-cap index down over 2.5% now, and you're seeing pain even in the small cap. So your advanced decline looking extremely poor, breadth of the market looking increasingly difficult, and this is on a day when, as you can see on your screen, the indices started in the green, and we've seen the pain get worse as the day has gone by. Of course, going to be interesting to see how this day plays out, but a 3% cut on the Nifty small cap, clearly not a good day for markets. Let's talk about some sectors, some stocks. You have the Nifty bank down 0.5%. Let me put that out of the way. And within the bank as well, the PSU banking index is down 2.5%. So that's where a chunk of that pain is. Mind you, HDFC is not only dragging the Nifty 50 index, it's also dragging the Nifty bank lower. But you're seeing Nifty auto also down 1% or thereabouts. The Nifty IT, let's pull up that one because that one was the only one where there was some bit of respite. It was a pocket of respite in this market, and that too has now slowly slipped into the red. Those are the contributories on the Nifty IT, which were all green at the start of the day today, but pretty much all in the red now except LTI Mindtree, where JP Morgan has a constructive stance. Let's pull up the Nifty IT index if we can before we move to our first guest. The Nifty private bank, there you go. So that kind of shows as to how even how markets have been pretty much through the day. The Nifty IT there, and the Nifty metal is down 2.6 odd %. The Nifty PSU bank down 2+%. The Nifty oil and gas energy index also down over 2%. So those are some real movers in terms of both the broader markets as well as certain specific sectors. The Nifty media, I just want to last off mark that out because it's 3+% lower. So that one also seeing a lot of pain. Again, a lot of the stocks there in the broader markets. Let me, though, quickly welcome on board Sachendra Nath, founder and managing director at Ugro Capital. Welcome, Mr. Nath. First off, many congratulations, 10,000 crore in AUM breached. Where to from here? In terms of growth, what can you expect going forward on this higher base?
Yeah, when I was listening to you, it sounds so bad. But actually, when you look at businesses have little correlation to stock market. I think so. What is most heartening about Ugro that it's a company which has reached 10,000 crore AUM, and we are a pure play MSME financing company. In 2022, we were 1,300 odd crore. So we have seen, since we began in 2019, we have seen both the IL&FS crisis, the COVID crisis, but still in 3 years, we have gone to 10,000 odd crore. And within the broader NBFC market, 10,000 crore of pure play MSME AUM put us roughly around 4th largest or 3rd largest MSME financing company. So our whole view have been that India's MSME market requires a very large, institutional play and large lending institution around it. Same thing what we have seen in consumer financing, the gold financing, second-hand vehicle financing. India definitely need a large MSME financing company. And we have both demonstrated the capital raise, 3 rounds of capital, almost 2,800 crore of total capital. We have demonstrated a very large co-lending business. Almost 50% of our business is in form of co-lending or off balance sheet. And we continue to build from where we are, actually. We have said that starting 2026, this company would continue to grow at 30 odd % every year. Right now, our entire focus is to expand out of our 4 vertical. We are expanding our micro enterprises vertical. In 2022, we were 25 location. We added another 50 location in 23. We are now roughly around 170 odd location, and we should be 250 plus location end of this year and 400 location next year. For our customer segment, which is 15 lakh to 15 crore turnover, we continue to see very strong resilience. If you read our MSME Sampark, which we do along with DNB, we are seeing a strong formalization of economy. The movement of informal to GST is happening at very strong pace. We are seeing very strong cash flow coming in the banking system, and we are seeing the bureau records getting matured. So, I think so. We would at the end of this year, we have grown 3,000 crore of AUM every year. We were 3,000 odd crore in 22. We were 6,000 crore in 23. We were 9,000 odd crore in 24. We should add, more than 3,000 crore end of this year and more than 5,000 crore end of next year.
Right. So tailwind being strong, that's the one takeaway that I take out of this, at least the first part of this chat. And the other piece is that you will add roughly 8,000 odd crore of AUM on the 9,000 crore AUM that you have in the next 2 years. Talk us through.
1.5.
Yes. Okay. So 2.5 years. Talk us
1.5 years.
1.5. Apologies. So FY26, is that the right way to look at it?
Yeah.
Got it. And so talk us through how asset quality holds up. And before asset quality, actually, talk to us about how loan growth is shaping up and what segments of the balance sheet or where are you lending to? What are the levers there?
So look, we service 4 customer segments. As I said, of the total 90 lakh crore gap in India, we believe that 90% of that credit gap belongs to this customer, which is in the trading turnover of 15 lakh to 15 crore. And we service most of them through 4 distinct channels. First, what we call the prime channel today, which constitute roughly around 50% of our asset block, where we lend to businesses which are in the trading band, turnover band of between, say, 2 crore turnover to 15 crore. Average ticket size on the secured loan size of around 1 crore, business loan of around 17-18 lakh rupees. We then focus on what we call productive asset financing. We do CNC, printing, packaging, plastic molding, and rooftop solar. Third is we do what we call through partners and embedded financing. And last but not least, our entire micro enterprises vertical. If you look at the construct of our total loan book today, 50%, as I said, is our prime customer segment loans. Around 10 odd percent is our micro enterprises. 10 odd percent is around our partnership and alliances, and the balance is the machinery and few others. Where it would change, in next 6 quarter or 8 quarter, this micro enterprises loan would become roughly around 30% of our total loan book. So it is not the volume number, but the growth, new growth will come from our expansion of our micro enterprises, and also that is what is expanding our ROA as well, because this is roughly around 18-19% secured yield business. When physical expansion coupled with our entire digital and data technology, infrastructure is expanding our business.
Right. So when you get to 17,000 crore, Mr. Nath, I'm going to rephrase this. Where does micro enterprise go, which is maybe 2% lower than your blended book in terms of yields? So therefore, where does this particular component of the book go, which is currently at 10% of your book?
So, I'm not putting the number of 17,000 crore. I hope that we, surprise the market more than that.
Sure.
Our expectation is more than that because we are building infrastructure now. We have said that we will expand our portfolio yield by 150 basis points. And that is happening through our micro enterprises loan, which comes at an average yield of right now at around 20 odd percent. We are hoping that with the expansion and growth volume, the yield will little bit compress for that segment of the market. But our overall portfolio yield, because of sheer reconstruction or change in the mix from a 10%, of the current loan book, which is around 1,000 odd crore, when it get to 30-35%, so roughly around 7,000-8,000 odd crore, this would increase the portfolio yield by 150 basis points.
Got it. Okay, and just talk to us about what component of your loan book of 10,000 crore now is secured versus unsecured. And as it goes from the current 10,000 to maybe 17,000-18,000 crore, how does secured and unsecured really shape up?
So we have maintained what you in your common parlance call unsecured loans. We have maintained that of roughly around 30%. Now,